Ladies and gentlemen, welcome to another edition of Live Q&A with Lobo Tigre, the Independent Speculator. I'm going to do my best to answer all the questions that we get in chat. I also have some questions sent in advance. I'm really here to do my best to help you. So I'm not going to pontificate too much. Let me make a couple requests to clients of My Take or the Independent Speculator. Please don't ask company-specific questions. Please don't reveal portfolio positions or my evaluations. That's what you pay for. There's no sense giving it away. You know me. If you've been reading me, you know me. I don't do cheesy promotions and stuff like that. I think it's best for everybody to be fair and square and on the same page. Another note to anybody participating, if you want to type your questions into the chat, happy to answer them. Please keep them brief. I can't keep reading essays, pages and pages. It's not fair to everybody. It's very boring to sit there watching me read and read and read. So I will do my best to answer as many as I can, as long as my voice holds out. But please keep it brief so everybody can enjoy the same thing. I do want to make a couple preface remarks, and I will be brief. Give everybody time to show up too and not miss anything. I've been in my sessions with clients and in my reader emails, I've been trying to maintain a balance here because I'm not the typical arm waving guy, the central banks are buying gold, so, everything's going to the moon tomorrow. Those kinds of hyperbolic claims are not my style. Or not my style. I think they don't serve the audience well. You get people excited, they go all in on something, and then nothing happens or it goes down. That's a bad outcome for the audience. I don't want to be part of that. So I'm always trying to be cautious, judicious, but I must say that I'm really quite excited about particularly gold and silver in the near term. But I think the whole commodities complex going forward is going to be the beneficiary of all the money printing we've been seeing over the last few years. We're not crazy. We're not wrong. Yes, long and variable lags and Mr. Market is crazy. The market can remain irrational longer than investors can remain solid. Yes to all of the above. But at the end of the day, reality does matter. The amount of money printing that's been done already, never mind what happens next, is still a whole lot of pig to go through the economic python. And I see that as, very inflationary going forward. It's very bullish for all commodities. And we just have to not time the market, but pick and time our own entry points to maximize the benefit. And one thing that I've said repeatedly, and it will answer many questions before you ask them, is that yes, I still see recession coming. I don't see it as a deflationary recession. I think the moment things get that scary, the powers that be will open the free money floodgates again and nip that in the bud. So I see, on the other hand, they are aware that voters hate inflation. So I see them struggling between this waffling, and in spite of their best intentions not to be the next Arthur Burns, I think that's what we're going to see Lagarde and Powell do. And therefore, my outlook is stagflationary with recession. So that means that for industrial commodities and minerals, I'm not bearish, but I'm aware that every time something like this happens, it's very bad for those metals and minerals prices. The energy sector as a whole gets whacked because recession is coming or recession is here. Same thing that copper. Doesn't matter if the cost of copper is below cost of production, the reality of, oh my God, there's a recession will make people sell, and prices can go lower than costs of production in this space, crazy as that may seem. So you've heard this before if you've been reading me, but I'm just really wanting to stress this because this is my overall outlook. I'm extremely bullish on gold and silver in particular in the near term. I'm bullish on commodities writ large going forward, but very cautious about buying anything in front of the recession that I see deepening, and still in denial in the world writ large. And when that changes, I expect those things to go on sale. So I'm looking for a sale price there. All right, well, that's really it. So not wanting to promise the moonshot here to anybody, but that's how I'm thinking. That's how I'm looking to deploy. The one exception to the industrial and energy minerals would be, of course, uranium. That does march to the beat of a different drummer. It's still below the incentive cost the industry needs. It's an industry that is both necessary and has been in liquidation for many years. And that is visibly turning around now. That doesn't mean uranium stocks won't get whacked if there's a market crash or more market weakness. It does mean, though, that absent, another Chernobyl-style event or something, I think that is about as sure a thing as that there is really in resource speculation. And so, if markets calm down as they seem to be now, that does put uranium back on the potential shopping list. And if markets do melt down, then that puts uranium on the buy while on sale list for sure. Okay, so I have some help here, and I have somebody monitoring the questions in another channel, so I'll be looking for that. I also have a few questions sent in advance, but live audience, you get first dibs. So let me see if I can scroll up here and take my first question. Khalid, can silver reach a triple-digit price? Well, here you've caught me in one of those, I don't want to be the arm waver, it's going to the moon kind of guys. But my answer is actually yes. I do think that can happen. If we inflation adjust for previous silver highs, then that puts us in, solidly above triple digits. It doesn't just trip over to 100, it goes over 200 if we inflation adjust. And that's not even using shadow stats. That's using the BLS's, highly manipulated CPI figures. So, does it have to do that? No. Am I promising that it will do that? Absolutely not. Could it do it? Yes. What would it take for that to happen? Well, that's really kind of where we get a little exciting here. Darth Silver and all that I've been called. We're in a situation where the very circumstances I started out describing this Q&A session with, where the potential recession could put industrial metals on pause for a while. At the same time, the same thing, that the recessionary scare or the inflationary scare, could send the demand for monetary metals much higher. That is the silver squeeze. That, never mind Reddit and all that, like, more power to them. I think that's great. But the real silver squeeze is when the copper miners and the lead zinc miners scale back because of industrial concerns, and monetary metals demand sends gold and silver prices higher. That's when silver really, really takes off and goes into one of its little mini manias, often leaving gold in the dust behind. So I'm not promising this. I'm saying this is the kind of circumstance we're looking at this year. This is exactly the setting that we could see play out before the end of this year. So I'm a speculator. I'm not promising a sure thing here, but it's certainly something I don't want to miss. These silver mini manias have been so rewarding to anybody that caught them. I would rather be long silver before and then just have it kind of peter along, shadowing gold if nothing happens. And if it does, catch a triple-digit silver mania, if that happens, we'll make a lot of money. And you know what? I'm not going to hold my silver stocks forever. As my friend Doug Casey says, these are not family heirlooms. They're, especially the little junior stocks. They're not meant for us to hand down to our children or our grandchildren or something. If silver spikes up to triple digits, I don't think that's a sustainable price. In nominal terms, it may eventually be, but in real terms, I don't think that's a sustainable price. So will I be taking profits? You betcha. Will I be closing out some positions? I would absolutely expect to. If anything just goes nuts, way above and beyond what the mine might be worth if they find it and build it and so on, just take the money, just cash in. All right. So silver gets the first question today. All righty. As far as questions sent in advance, I like to flip back and forth between questions sent in advance and questions live. So I got a question about this recession question and deflation. There's a lot of smart people out there, Lacey Hunt and others, who are saying that, we're headed for really rough waters. There's a credit crunch coming. The deflation is coming, that, things will get so bad that the piper will finally have to be paid maybe it becomes Doug Casey's famous Greater Depression, right? And to be fair, a lot of people point to gold's performance during the last Great Depression in the mid-30s. And they say, well, gold did great during the Great Depression, so don't worry about a depression. Well, that's really kind of not fair, because at the time, gold was the dollar, or the dollar was defined in terms of certain amounts of gold. So to say that gold did well in the Great Depression is kind of like saying, it's not kind of, it is saying that cash did well in the Great Depression. And in today's world, where the currencies we use in the US and other countries have been completely divorced from gold, that's no longer the case. Gold is real money, you and I know probably, but the world, the trading world, the investors out there, the average person sees gold as a commodity like copper or pork bellies or whatever. Not entirely, but that's in the financial world. That's the dominant view. So I think things are different. And if there was a true deflationary crash, I could see that being a real headwind for monetary metals. Could, I say could, I don't say will, because the very same thing could just really squeeze those sphincters, get people on the fear mode, and that fear trade, that safe haven demand could actually, boost gold and silver even in a deflationary, crash type environment. So we're getting a little science fiction-y. I don't know what's going to happen. I'm pretty confident saying that there's going to be a recession. I'm pretty confident saying the Fed has not beaten inflation. Base effects don't actually make the cost of life any cheaper. So I think we're looking at economic weakness, remaining high levels of inflation. That means stagflation, and I expect that to be very bullish for gold and silver going forward. The Lacy Hunts of the world, no disrespect. I just have a different view, and maybe it's not even that different. I think even Lacy and these others would say that if the government pivots back again, if what they foresee starts rolling out, then the easy money floodgates might reopen, or I think will reopen, and therefore make that scenario go away. My problem with these predictions isn't that I can't see them. My problem is that some of the pundits present them as like, this is a fact. It's going to be deflationary. There's a certain famous economic commentator who's been calling for lower gold prices going back to 700 since the crash of 2008. And I just think that call is wrong, not helpful to investors out there, certainly not to gold bugs and resource speculators. All right, so questions live. We got the silver. What is the largest position I have as a percent of my portfolio? Should a limit a position to 5% or not? This is something that I've covered fairly frequent. It's not a bad question, but bear in mind that I'm not like a money manager with millions and millions that I need to have a very systematic and cautious approach to. And my positions are still, I'm doing all right, but my positions are not so large that me buying or selling a stock is going to, unless it's like a real penny stock with no volume, my actions are not going to move the market. I'm not a big enough fish in the sea to move your Franco-Nevadas or Newmonts or Brics, the big go-to names in the space. I just don't matter. My purchases don't matter. So some of these systematic considerations just don't bear on my situation. But the key thing, I think the more important thing to remember here is that a really great speculation is hard to find. Even in the Independent Speculator, I have a monthly edition. It's much more than a monthly, newsletter. It's a whole service. But I do have a monthly edition, and I don't promise readers that I'm going to have a new pick every month. I think that would not be in their services, because you just can't have a great idea every month. Not every month are you going to find something that makes the grade, that ticks all the boxes. That's really a great speculation. The corollary to that is when you do find something that's a great speculation, you don't want to be Procrustean about it. You don't want to say, oh, well, this is a fantastic speculation, but it's a silver stock and I've already got too many silver stocks in my portfolio, so I'm just going to pass it by. So there are a lot of these allocation questions that really don't apply, I think, to the judicious speculator who is not of market moving whale size. And it's a mistake, I think, to pass up a truly tremendous opportunity. As far as individual positions within the portfolio, I don't have a number like 5%. It clearly putting all your eggs in one basket is not a good idea. Having so many eggs scattered so far and wide, here we are, it's Easter weekend. You all know what happens when you hide too many Easter eggs and the kids don't find them all. A week or two later, you start, what's that smell? There's something analogous with stocks. If you have too many that you can't pay attention, you can't keep track of them, that's not good either. A litmus test that I often suggest for this is if you see a press release from a company that you own shares in, and you don't immediately know what it's about, or at least recognize the name of the property where the drill results or the mining operating results are coming from, if you have to look that up, you've probably got too many stocks. Whatever the right number is for you, it should be something that you can pay close enough attention to make informed decisions on your speculations. 5%, that may not be a bad number. But one more thing on that is, if I've got a winner and it's just running, I'm not going to trim it back because it goes over 5% or some arbitrary number like that. I will take profits if it makes sense to take profits. I love having a free ride. I'm a speculator. A lot of the stocks that I pick are smaller, very high risk stocks. So if I can go risk-free, recover my initial investment, and still have just as much money or more in the speculation as I started with, that's just a beautiful thing. I can sleep at night. So that's something I look to do and have done with most of my uranium stocks. They did so well in the last big run up to $50, $60 that I managed to get my initial investment back off the table. And I know at the time, a lot of people screamed at me, Lobo, you lack conviction. You're a traitor to honest, good uranium bugs out there. But, those people have gotten awful quiet lately with uranium going sideways for the last almost year. And I have had a few people write in, oh, you were right. I should have taken profits when you did. So that's a strategic consideration about locking in gains. I call it the upside maximizer. There's a free download for that on the website, the report explaining how my upside maximizer strategy works. But I wouldn't do it just because something tripped over 5% or 10% or whatever. In fact, right now, the uranium stocks are still so much higher compared to where they were in 2018, 2019 when I started buying, that uranium, I would say, is perhaps overweight in my portfolio. But I'm not going to sell them just because of that. I still think uranium is one of the, like I said before, it's one of the surest things, absent a major, beyond Fukushima, but Chernobyl style event. I think the new nuclear renaissance goes forward, and there's not enough mine supply. Low prices will cure low prices there. So I hope that answers the question. And as always, I do answer questions even in the free weekly newsletter, the Speculator's Digest. So if I'm not quite nailing your question or I don't cover it for you, please just let me know, and I will take it up in print if I can, if it's of general interest. Okay, another question sent in advance. The platinum question. Somebody asked me, what are my thoughts on platinum over the next couple of years? And my thoughts are the same as platinum over the last couple of years and platinum over the last decade. Ever since the price of platinum dropped below the gold dollar exchange ratio, and I use those terms specifically, I avoid using the gold price nomenclature because I think that's misleading, because gold is money. And you can see it move as money on a daily, weekly, monthly, long-term basis in response to what happens in the larger world of money, monetary finance. The long-term chart of gold versus the dollar is a giant X for reasons that we all know and understand. So the gold-dollar exchange ratio, aka the price of gold, dropped rose above platinum more than 10 years ago and has remained there ever since. And ever since then, even the first year when platinum was just a little less than gold, never mind half the price of gold, there were people saying, platinum's more rare than gold. It's got to go back up, And every year that call has been wrong. Or, okay, there have been some years where platinum went up a bit or even a fair amount, but it's never caught up with gold. It's not gone back above the price of gold. And I think there is a good case to be made that the use case for platinum has changed permanently. Yes, I get that palladium was substituted for platinum, and palladium got so expensive that you could, flip back to platinum and maybe create a little bit more use there. But guess what? Palladium prices have finally come back down to earth as well. And so the incentive to switch back, and by the way, it's not like you can just sprinkle platinum dust in the machine instead of palladium dust. The location of the catalytic converters in the cars is different. The operating temperatures are different. You need to change production lines in more ways than just switching out the platinum there. So it's not so easy to just flip from one to the other. And I'm not a metallurgist, I'm not a material science engineer, but I understand from some who are that actually once the car makers flipped to palladium, they found that it was actually better than platinum in many applications and uses. And I'm not just talking diesel versus gas, I'm talking in other more technical ways, such that they might not switch back to platinum, even if platinum remained cheaper than palladium for long enough for them to make such a decision. And then there's, of course, the electric car question. And yes, it will take a long time, and yes, electric cars are still a small part of the market, but it's growing really fast. And we're also going into a recession. And the last time we've had a recession, the auto industry always takes it on the chin going into recession. And it lasts a couple years. It takes at least 2 years for the auto industry to recover from a recession. So, to bet on platinum because the auto industry, because it's cheaper than gold, because palladium is more expensive, and because the electric cars aren't there yet, I just think is not having a well-balanced view of the overall demand scenario. And I think platinum bulls really need to think hard about how the use case has changed. And even if it will take 2050 before we're all electric and you can't find a gas station anymore for gas guzzlers, that doesn't mean that the share of the market will tilt so far towards EV by 2030 that the powers that be are pushing hard for, that the demand case for platinum and palladium both seriously deteriorates. And it's an open question where we'll be even just coming out of the recession. If we're coming out of the recession in 2025, 2026, really coming back to the rebound then, by then the share of electric cars in the market could be such that even a rebounding economy doesn't help platinum or palladium. And again, I really dislike the use of the term precious metals. An expensive metal doesn't make it a monetary metal, and neither platinum or palladium, Paul Krugman notwithstanding, neither of them are monetary metals. So it's a mistake to lump the PGMs, platinum, palladium, and other metals in with gold and silver, which have and do still circulate as money in parts of the world. So maybe a bit of a long-winded answer there, but I get this a lot. And I'm sorry, I'm just not a platinum bull. I don't foresee any circumstance that's likely to make me a platinum bull unless it's some new technological revolution years down the road. Like the favorite one that people like to talk about is hydrogen cars and the platinum that goes into the hydrogen catalysts. Yeah, that might happen. But we're years from that. Even at the most optimistic pace, we're talking about probably a decade before there's enough mass adoption of that technology to have a substantial impact on the platinum market. So, it just makes no sense to run out and buy platinum stocks today based on, some science fiction scenario of what might happen in the 2030s with new platinum uses. For now, for the investable future, my position is that the use case for platinum has changed, and I'm not bullish on either platinum or palladium for the investable future. So, sorry. Okay. Questions from the live audience. My take on Amex. I have said in advance that I'm not going to answer company-specific questions. Very sorry, but that is what clients pay me for, and I don't think it's fair to them to give that information away. Anything on the markets, the metals, broader investment issues, all of that's fair game, but I'm not going to evaluate any stocks in this Q&A. I do in live Q&As for clients, but not here. Any books I would recommend on mining? Yes and no. Mostly no. I mean, there are great books out there on geology and mining. There are very few on economic geology, wedding these two things together. And there's none that I know of. Maybe Jeff Clark's new book would help. I haven't read it yet. But there's very little that's targeting what we do as resource speculators and telling us, what we really need to know. It's a project I've got. I have, by the way, no book yet. It is a project of mine, and in the future, I hope to fill that void. But I have cheat sheets on the website. If you go to our website, use a little magnifying glass tool to search and put cheat sheet in there, or just cheat, it should pop up several cheat sheets that could be seen as chapters of a forthcoming book on economic geology and mining for resource investors. There are, Jeff is a very good writer. He and I don't see everything eye to eye. He's maybe more optimistic about some things than me, but he's a very good writer, and he's very good at explaining things to non-technical people. That was actually why I hired him back in the Casey days, is that he's really good. He's like that himself, and that it gives him an edge on explaining things to people. So even though I haven't read it yet, so I can't give a full endorsement here, I'm sure that Jeff's book probably is very helpful for people trying to understand the basics here. I also understand that PDAC, the Prospectors and Developers Association of Canada, has materials that they distribute, reports and things that are available for people who want to understand more. Other than that, sorry, so much of it is just so technical. Even if you're interested, the eyes tend to glaze over at a lot of this stuff. Okay, questions sent in advance. How real is the risk of the powers that be confiscating gold in the West? And, could the Brics countries use that to launch their gold-backed currency or not, and so on? So the risk, I think, is real. It absolutely should not be said it can't happen here, not only because of FDR's seizure of gold bullion in the US in the 1930s. If it can happen in the US, we still have the same constitution, it can happen anywhere. And also in Europe, the talk about bail-ins, what happened in Cyprus, that wasn't gold specific related. But when central bankers tell you that your money on deposit really isn't yours, it's theirs to do with as they please, they are telling us that this is very possible. Now, how likely is it? I think that's actually quite unlikely anytime soon. Oh, sorry, one more thing. When FDR grabbed all the gold in the US, nominally, that gold was the government's. It was the government's money that it issued. It issued those coins in circulation and notes. So they didn't seize your jewelry or your gold nuggets. They issued the gold bullion that the state had put into circulation and instruments based on that. So they were kind of calling back their own stuff. That's why FDR could do it by executive order. To seize private property would, I don't know if even, maybe the asset forfeiture laws could be used or some excuse like that these days, since the Constitution has been so weakened. But it shouldn't be possible, actually, without a constitutional amendment. But these days, unfortunately, the Constitution isn't what it once was in terms of the law of the land. But anyway, my point is just that gold is no longer the currency of the United States. So the same mechanism that was used before could not be used again. what would have to be done now to seize people's privately held, private collectible tokens would be a big deal. It would be draconian. And before they could go that far, before they would do that, I think things would have to get really bad. And they didn't even talk about it in the crash of 2020. They didn't talk about it in the global financial crisis, not even on the radar. So I think it would take something like Doug Casey's Greater Depression. We wouldn't just have to be in a recession. If there's a recession, I think the powers that be will think they can fix it. They'll just paper it over. They'll just put more free money out there. They'll kick the can down the road again. And they have so often in the past. I can't even say that I blame them for thinking that. They might be able to kick the can down the road again. We'll see. But since they think that way, I think it's very unlikely that they would go to any kind of gold or silver confiscation anytime soon. Things would have to be so bad they have no choice. And I think even they would understand that if they did something like that, they would be admitting that the jig is up. They would be admitting that their fiat currencies are the con games that we all know them to be, here in this audience, I assume that. And that's something they really don't want to do unless their backs are against the wall. So can it happen? Yes. Will it happen? Maybe in due course. When? I don't have a crystal ball, but not soon. I think things would have to get much worse, and we'll see it coming a mile away. Things will be so bad. We'll see a lot of other things that they try first before they go that far. On the Brics question, here's another one where I want to be careful because I don't want to, promise the moon or say too much that's not supportable. But I do think actually that a Brics gold-backed currency, if not the most probable outcome, is one of the top contenders out there. I think this is something that has a pretty good chance of happening. By that, I don't just mean, 1, 2, 3%, maybe not more than 50%, but maybe 20, 30, 40%, maybe more. I don't know. I have no P's and Q's to probabilistically put a number on that. But this is a real deal because this isn't just hypothetical anymore. Let me take a step back. People have been talking about this for more than 10 years too. And if anybody went out, 10 years ago and bought a bunch of gold stocks because the Brics countries were going to back a new gold currency with gold and that was going to send the price to the moon, they would have suffered so much pain for so long before gold finally came back up again to hit new nominal all-time highs, that listening to that argument would have been a disservice or would have done them harm. So I'm very cautious about this sort of thing. Any of these big ideas that someday they're going to send it to the moon. Yeah, well, someday is not an argument for what I need to buy now, what I need to speculate on now. So that having been said, this isn't just a theory anymore. The Russians and the Chinese, amongst others, really don't want to be dependent on the US and the dollar anymore. And they are doing everything they can to move hastily in that direction of some kind of alternative. China going to Saudi Arabia and setting up their deals there and, brokering peace in the Middle East. China working out, yuan payments with not just Russia, but Brazil. I mean, we're seeing the Brics countries doing this now, or at least de-dollarizing. The de-dollarizing part is something that's happening now. This is really important. Now, the gold-backed part, this is more theoretical, but do the Russians trust the Chinese to maintain a stable yuan, especially if it becomes a reserve currency in the world and they gather some of the exorbitant privilege currently reserved just to the dollar? I can imagine them being just as profligate as American politicians if they had that privilege. Would the Russians trust them not to go down that path? Yeah, I wouldn't if I was Russian. Do the Chinese trust the Russians to maintain the ruble's value? No, nobody trusts the Russians. Not even the Russians. They're buying gold in record numbers. The Indians or anybody else, none of these guys trust each other. So it's not just that the yuan has a problem becoming an alternative to the dollar. Even a non-dollar basket of Brics currencies, it would still have that same problem of trust. Therefore, it actually makes sense to me that, backing a Brics currency with gold would solve the trust issue. It would enable them to present a viable, credible alternative. How much you trust them to keep the gold, I don't know. But between those different powers checking on each other, division of powers, separation of powers is a reasonable way to inject some level of trust in the system. So, would I trust the Chinese entirely? No. Would I trust the Russians to distrust the Chinese and check on them? Yes. And vice versa. This is something I think that can make a Brics gold-backed currency a reality in due course. And this is not the sort of thing that happens overnight. If it happens, I think it'll take years to roll out. I think we'll see it coming. They'll talk about it. They'll announce it. Maybe after they've accumulated enough gold that they think will be enough. And that is an interesting point, that we see these headlines about record amounts of gold accumulation among central banks, but it's not everybody. Canada hasn't decided that maybe it was a mistake to sell all its gold. It's the Brics countries that are leading the charge in accumulating gold. So, what I'm saying is, I think this is a considerable outcome that is worth looking forward to. Now, does it make any difference to which stock I'm going to buy today? Absolutely not. Particularly for gold stocks or gold and silver stocks, I'm doing that anyway because of the inflation writing on the wall, because of the macro situation, and particularly in the near term, because I think the Fed is going to be the first central bank, major Western central bank anyway, to pivot in a big way. And that's bearish dollar, bullish gold, and other alternatives to the dollar. So I don't need this science fiction story in the future where, there's this gold-backed alternative to the dollar out there to make my decisions now. And my caution about this is just, it's an exciting idea. It's one I'm even willing to believe is likely, but it's not something that I'm going to make my investment decisions now on. And I hope everybody will remember that. Okay, live audience, let's see. Trying to keep up with the questions here. Oh, there's a bunch of them. All right, when evaluating drill results for lithium and uranium explorers, I am clueless about what are bad and good results. Do you have any tips, ranges? Okay, well, that's actually a fairer question than, because one of the cheat sheets I have is about evaluating drill results. And it's easier with some of the sort of mainstay metals that, copper, gold, silver, those I understand well. And the types of deposits they occur in and what those drill results mean in a certain context. Every project is different, but there are rules of thumb that can help us, pretty reliably say this is pretty good or nah, that's not so good. For lithium and uranium, it's different. Actually, I would say uranium is easier than lithium. One thing to remember is that there's different lithium products, and different deposits lend themselves to the carbonate or maybe going straight to the hydroxide, and even the deposit aside, maybe proximity to the end user. This is a bulk commodity, remember. So, the proximity to end user, offtake agreements, all this can determine, what process, what product even, and therefore what kind of grade it's going to be good. So the short answer is that I don't have a real good answer on lithium on that. You can do comparables. Obviously, if it's a brine, you can compare to what SQM does or Albemarle, and anything that looks better than SQM or Albemarle, well, devil's in the details, but that's a good sign. Anything that's not so good, well, you need to dig more before you can be confident. If it's hard rock, that's even more variable. And my answer there is basically wait for a feasibility study. Maybe not a full feasibility study, but at least a PEA, a preliminary economic assessment. And probably, if the PEA is full of assumptions, if they assume industry average recoveries or something, that's really not useful. I would look for a pre-feasibility that has project-specific metallurgy. At that point, if that's useful information on how valuable is this rock. For uranium, that's a little easier. We have, fairly well established, what it takes to make money for in situ recoveries. And, you can make money with, a couple hundred ppm. But if it's, say, over 400 ppm for in situ mining, that starts looking pretty rich. Anything north of that, it has an easier pathway to profitability. ppm is parts per million, by the way. It's the same as grams per ton. But when you have a metal like copper or uranium that's priced by the pound, you tend to look at percentages and ppms rather than grams per ton. For gold and silver and very expensive metals, where a gram actually matters, then we look at grams per ton. For hard rock mining, it's again more variable, depends on your cost, but it has to either be really big bulk tonnage to make the low grade stuff work, or you've got your high grades in the Athabasca Basin or similar things to that. My personal way of dealing with this, it's kind of a cheat, maybe I'll add it to the cheat sheet, is, since the Athabasca Basin exists, and since you can get multiple percentages of uranium in your mineralization, why take the chance on something that's ppm in the ground in hard rock mining? And somewhere in Africa, it might work, but compared to something that's solid percentages of uranium in the Athabasca Basin, where uranium is permittable and you don't get shot with AK-47s on the way home from work and that sort of thing. I just feel much more comfortable there. I'm not saying it's the only place to invest in, but in terms of grades, I think it's really significant. Like when you see these companies, they'll put out a press release and say, oh, these are really great grades, for non-Athabasca Basin uranium. Every time I see something like that, I think, well, gee, but there is Athabasca Basin uranium. So why do I care about okay grades for non-Athabasca when there is Athabasca? I'd rather bet on that. And then after that, I'm sorry, devil's in the details. If you're not sure, if you can't tell, wait for solid metallurgical test work to give you some indication of processing costs and help you determine what's good grade or not. Hope that helps. And don't forget that there is a metallurgy cheat sheet on the website, as well as a what is good grade cheat sheet on the website. Hopefully those will help. All right, questions sent in advance. In 2020, when gold went over 2,000 an ounce, mainstream market was bought up billions of dollars of gold ETF. We just went over 2,000 again, and there seems to be no movement. What's the difference? What changed? This is something that I've written about, talked about, posted charts about to my Twitter account. By the way, if you don't follow me on Twitter, you don't have to. I understand some people are not happy with current management. Some people love current management. Some of them just don't like the platform. But we're working on an app that will enable me to communicate on a daily intraday basis with breeders. Until that's done, I'm using Twitter for that. So if you like my analysis and you like my way of looking at things, and you can't wait for every Saturday for me to write that digest or the monthly editions, signing up for my Twitter account is one way, because I'll comment on anything significant that I see affecting our investments in Twitter on a day-to-day, intraday basis. But anyway, this question about the difference, I've posted about it all over the place. And my take on this is that sentiment has gotten so bearish, and it's partly been driven by this, I think, incorrect idea that what happened in 2020 was a spike. It was not a sustainable, it was not a response to regime change. It was not a rational market reallocation in the face of the end of easy money and higher inflation going forward. Most people don't think that way. It certainly doesn't seem like the comics traders in Chicago and London, other places, think that way. They look at the past, recency bias, and the most recent example of a big ramp up in gold like that is what happened in 2010 to 2012. And what happened at the end of that? It was kind of a flat top peak that dropped off a cliff and delivered, a world of pain to gold investors for years after that. So I think that part of the mainstream that cares about gold at all has been waiting for that other shoe to drop. They see 2020, or have seen 2020, as being like that spike up in 2010, 2011, and they're waiting for that fall off. And that permeates the market. And I think, on top of that, you just have within the gold space all this bearish sentiment, people who are just disappointed that we have such high inflation and gold didn't go higher. Somehow, 2000 is not high enough, but I understand the reasons for that. So you have industry insiders that are disappointed and bearish, and you have, the broader investment world out there expecting gold to fall off another cliff like it did last time. And that makes it really difficult for the equities to keep up, not just the ETFs, but just that interest there to keep up. And actually, I think this is a very good thing. The main chart or charts that I've posted have been charts showing the difference between this time and what happened before. There's a chart on the Twitter. I'll have to repost it somewhere permanent. I'll put it in an article. Oh, it's in one of my recent interviews. There's that chart there that shows overlapped the ramp up in 2010, 2011, and then the fall off in 2012 versus what's happened this time. And you see the ramp up, and it's kind of spooky how similar it looks, that plateau earlier on. But where the other one fell off in 2012, this one has continued sideways and now looks like it's breaking out upwards again. So I'm not a technical analyst, but for the chartists out there, my view is that instead of it being a spike like it was last time, or a flat top spike, I think this time it's a shoulder and it's going higher. I'm very optimistic on this, but I'm in the minority. And until that attitude changes, the mainstream flows back into the ETFs or the stocks are going to be lagging. And frankly, I think this is spectacularly good news for anybody late to the game, anybody that isn't all in or isn't fully deployed or is brand new to the space. This is terrific. Gold over $2,000, I think it's going higher, but it's hard for me to say that gold itself is cheap. But the gold stocks are cheap. They're objectively cheap in nominal terms. They're objectively cheap in real terms. If you look at, the HUI or any of these indices, priced in gold, and they're really, really cheap. They're near record lows in many cases. So I think that's great news. If you want leverage, if I'm right about where gold is going and you want leverage to just the metal, then you want the stocks, and those are still on sale. So how great is that? Well, we have what looks like a breakout. Looks like, not a promise. We have what looks like a breakout happening, and there's a way to still buy into the potential upside on the cheap. So the question then becomes, what will change this? And, crystal ball question, who can really say? My sense, and I've talked to some of my peers about this, Adrian Day, whose judgment I respect a great deal, and some others. Our sense is that a significant break above new nominal all-time highs, and not just an intraday spike or some wiggle or something, but going above the previous all-time high and staying there. I think that'll really light a fire under this market. Even just coming close to it. Last week, when gold was, above 2,000 and it got above 2050 at one point intraday, and the talking heads on mainstream financial media were covering it. There was a whole segment on gold on Yahoo Finance, where all they want to seem to talk about is Tesla and Chipotle and the latest meme stock. So, seeing an actual commodities investor talk bullishly about gold on Yahoo Finance was a kind of a seminal event. And I've tweeted about things like this, and there's almost always this knee-jerk reaction. Oh, CNBC said something about gold. That's a sign of the top. Sell everything. No. Just no. Yes, at some point when the mainstream is all going all in on gold, when gold is all that CNBC or Yahoo Finance or any of these others are talking about, I think that will be an indication to contrarians that, maybe it's, the mania is here and it's time to start taking profits or even exiting some of our positions. But we're nowhere near there yet. Just because out of the thousands of stories that Yahoo Finance runs in a week, there was one segment that was bullish on gold. I don't think that's the sign of a top at all. But that's my answer. We'll see if I'm right. I think new nominal all-time highs in gold is newsworthy on its own in the context of still high inflation and recession, something that rhymes with stagflation in the 70s. It's just an easy thing for reporters to latch onto. Like, what happened the last time we had stagflation? Gold went nuts. Oh, guess what? Gold's at new all-time highs. You don't have to be a gold bug to put that 2 and 2 together. And I think, that kind of momentum chasing money that sloshes from one thing to the other could easily decide that gold is the flavor of the day. And if that silver mania kicks in that I mentioned before, silver could do it on steroids. Not a promise, just a potential. Okay, live audience, next question. Can I comment on what I feel will happen long-term bonds, both short-term, long-term? Okay, I'm not a bond king, so probably the short answer is no, I shouldn't really go there. One slight nuance is just to throw in is that it often seems like the bond market doesn't do what you would think it would do. It's striking how many times, as it became obvious that the Fed would have to raise rates aggressively, before it happened in 2021, even, it was obvious the Fed would have to raise rates, and in 22, as it starts happening, and there were plenty of times where people piled into bonds anyway, like some other fear or something drove them to buy even ahead of the Fed selling. Remember, if the Fed is jacking up rates, they do that by selling bonds. So who in their right mind would buy bonds ahead of the biggest 800-pound gorilla of them all, the Fed, selling? And yet they did. Some institutions have to, some people do it for other reasons, or, particularly on the long bond, they think that the Fed's interference it will pass, and in the long term it'll go out. So just, I'm not the bond king, but just beware of these bond kings that try to convince you that they know what will happen, what the Fed will do. Right? Any statement like that is always very dangerous. One other thing, though, is worth considering, and I'm not a bond guy. I haven't done this myself. I've thought about parking cash in short-term bonds. When I can get a short-term bond over 4%, yes, it doesn't keep up with inflation, but it does better than cash in the bank. So if I've got cash that I'm not going to use in the nearest term, a short-term CD might not be a bad idea, or tips are limited, and I wouldn't want to get into anything that had duration of more than a few months, because the situation is so volatile. Even those talking heads on mainstream financial media have been talking about how the bond market's been more volatile than the equities market. And the bond market, 40 bips trades intraday, swings. It's like a meme stock. So that being the case, just beware. But rationally, I can see the logic, particularly for cash equivalency in the near term. Tina has given away to Tara, right? There is no alternative. There always was a raft of alternatives, but for mainstream investors, excuse me, for mainstream investors, Tina giving away to Tara, there is a reasonable alternative, is a big deal. This is quite significant, and something to consider. Okay, questions sent in advance. I've talked about position sizing and averaging down. A painful question. What's the biggest percent loss relative to my portfolio I've ever taken? Any lessons? Without getting into details, the questioner has something, approaching 100% loss on a large position, a large chunk of his portfolio, and he's wondering what to do. So I can't give individual advice. Can't tell this reader what he should do with that position. To answer the question, yeah, I don't actually have numbers on this on the tip of my head. I don't think I've ever owned or had a portfolio of less than about 10 stocks, and I tend to spread my money around fairly evenly. So even though I don't have a 5% rule, it was unlikely that anything I ever owned got above 10%. And there have been very few that I had a wipeout. The worst the worst trading experience of my career was Banks Island Gold. And that was almost a near wipeout. I think that was about an 80 or 90% loss of capital, given my starting point. And part of the problem there was, when they hit the wall, it was, they were this close to winning to make, they had the mine up and running, they were processing, and then the heavy rain caused a small spill, like a pickup truck full of benign rock. It wasn't acid draining or anything like that. But the natives flipped out, the regulators flipped out. Later turns out, maybe other corners were cut, but at the time, the news was a small thing, really, in the scape of things. But it caused an immediate shutdown. The stock tanked big time. And this was back in my Casey days, and I still do this today. Is anything that I own that I write about, I give readers first dibs. If I'm going to buy something, I publish a shopping list, and I tell them before I'm going to buy, what I'm going to buy, what kind of prices I would consider good entry points. And if I'm going to sell, I tell them I'm going to sell, and I give them 3 days head start, which exceeds SEC requirements. But I think it's fair. Not everybody reads everything every day the way I do. So, when Banks Island hit the wall, it was kind of, I put out an alert. And by the time I could take any kind of action, it was just too late. But at the time, that wasn't a very large position. I think it was about $10,000 or something. I think it was $10,000. So it didn't do me much harm. This is a good case for diversification, not putting too many eggs in one basket. Without giving individual advice, the question, what would I do now if I had a big position that I was looking at a wipeout on? And without knowing the individual story and whether there's even still a bidder or not, the general answer would have to be is I would take my lumps and move on. If there's a buyer now, even if it's pennies on the dollar, that's much better than no buyer at all. Maybe here's an example. Pure gold mining. I don't evaluate companies, but this one's toast, right? You can't even trade the stock anymore. So I could talk about it. It was a company we covered in my take for a long time. When things started turning south or not going as planned, I was very clear to readers. It was a thumbs down. It got a thumbs down. And, every time it would have bad news, it would go down and there'd be a bit of a rebound. And it was run by famous people, the Marco Day team and so on. And there was always this hope that it would come back. And people would say, well, should I hold on? I didn't sell when you sold, but now I'm 50% underwater. Should I sell, or, might Marco Day save this at the end of the day? And the answer was no, thumbs down. This is very unlikely. And it got from very unlikely to this is a disaster. Get out, get out, get out. And it got even worse from there. Each waterfall down. Well, now I'm 75% down. Maybe it's oversold now. Maybe it'll come back. Well, it's 95% down now. It got to where I described it as, I can't remember exactly what the words were, but it was something like a dumpster fire on a sinking ship. Is sell immediately while there's anybody dumb enough to still buy. That was the last take before the bankruptcy resulted in the cessation of trading, and there was no longer any ability to get out. So when necessary, I'm brutally clear in my guidance, and the odds are always against a recovery. When things go seriously wrong with a story, whatever it is, even if it has the most famous management, like, on pure gold mining, Eric Sprott took a bloodbath on that. Marco Day himself. I don't know what his losses will be, but, from the insider reporting, it looks like he went down with the ship, and maybe that's good. It's good that the captain went down with the ship and suffered the consequences. He'll remember that lesson, I'm sure. But without knowing more specifics and without crossing the line into getting individual investment advice, the cautionary tale here is it doesn't matter how big a portion of your portfolio is. If the odds are against a position that you own ever recovering, you know what you have to do. You know what the math tells you you should do. The only exception to this in any scenario that I've ever given any weight to is if you're looking at basically scorched earth. If selling you the stock, not at pennies on the dollar, but on fractions of a penny on the penny, right? If you're down to 0.0000 whatever, and selling the stock is going to grab, net you, after commissions and everything like that, it might not be enough to buy a large pizza for your family. Well, at that point, why bother? Why even bother with the commissions? Who knows? Maybe they come out of bankruptcy. Maybe they roll back the stock. Maybe they make some big discovery, and you're unlikely in that case ever to really be made whole. But your 0.001 cent might actually become a penny in the future, and then you might be able to get out, with less of a loss. That's total scorched earth scenario, where selling would bag you so little, would net you so little that it's not even worth the trouble. That might be the only exception. Other than that, as long as there's a buyer and the math tells you this is a losing position, there is more downside likely than upside, then you know what you got to do. And I'm sorry. Okay, that was it for questions sent in advance. Going back to live audience. A few newsletters ago, you said, oh, I'm getting these questions updated. Am I surprised uranium equities have been so weak? We'll get to the other one in order. No, yes and no. I'm not surprised that uranium equities have been weak, given that uranium has been going sideways, therefore not generating excitement. And uranium stocks are stocks, and the stock market has been off. And as the mainstream starts to come to grips with recession, it is characteristic of markets that the energy sector, so-called, sells off. This energy sector is an artificial kind of construct, but anyway. So that the uranium stocks have responded the way they have under current market circumstances is not surprising. That uranium itself, however, hasn't done better, I will say now is a little surprising. It's been in a 2 steps forward, 1 step back, sawtooth pattern upward since 2016. So to see it go sideways this long, it's going on a year now. That's an interesting change in the pattern. Now, could that be bad? Could that be a signal it's going to turn down? Never say never, but I think not. I think the fundamentals are extremely robust here. We see, it seems almost every week, it's not just some happy story about uranium or some new coverage in the mainstream media. It's new demand. It's new plans for new reactors. Eastern and Central Europe in particular, despite the Germans, are really pushing hard in this direction. And the Germans themselves, it seems like if hell didn't freeze over, Germany did, and they put off closing down their last nuclear reactors. That was a seismic event in the industry. And you've got the Brics countries building them as fast as you can. You've got even the US talking about new reactors. The advanced small modular designs are gaining a lot of ground. And shovels are hurting dirt around the world on this. And then you've got these new, some of them are not end users or quasi end users, but you've got SPUT, you've got this new Kazakhstan fund, other funds, and you've got the United States government itself becoming a new buyer in the marketplace. So I'll be honest and say I'm surprised that uranium, I'm not surprised that it corrected 2 steps forward, 1 step back. I'm not surprised it pulled back from 60 to 40 and then came back up again to 50. I am surprised that it's taking longer for it to get going again. What will change that? I think as long as we're looking at deepening recession, there is a headwind that can potentially knock spot prices back. But I think the fundamental here really is going to be these long-term contracts. This has been my big thing. I know my friend Rick Rule likes to talk about Japanese restarts, but that's already on the table, and it doesn't seem to be helping. I think it's very different from, Cameco finally, or Kazatomprom, or one of these producers finally coming and saying, here are the new contracts, and here's the price per pound we're getting. And they tend to avoid doing this, but in their financial statements going forward, we should be able to figure out, what they're getting for these. And at some point, some of these sellers, they will announce their prices. And I expect those to be higher than spot, and I expect those to drag the spot price up. If they're significantly higher than spot, you could see uranium prices rising even when oil and gas prices and industrial minerals are falling in the recession. I guess I don't have a very clear, do this right now at this point. And here's the path to do this, and you'll make a ton of money. So I don't have an answer like that for you now. But I remain extremely bullish. My surprise has been how long the sideways move in uranium has been. My optimism isn't just theoretical, however. Actually, uranium trading sideways when so many commodities dropped and the broader energy sector retreated. Oil went from 120 down to under 70. For uranium to trade sideways in that environment is actually an outperformance. That's a beat, and that's a good sign. So exactly when these things happen, I'm still concerned about a near-term harm, especially if the fallout from the banking panic in the US causes a major retreat in equities. I think that would hurt uranium stocks. But absent that, if things settle down, and they do seem to be settling down in the US markets, if things settle down, then I would be willing to go back into the market looking for uranium stocks. Because even though I can't give you that road path, my take is this is something that is happening now. These contracts that I'm saying I think are the most likely drivers, they're being negotiated and signed right now. And we will see news flow of that this year. So my bullish case for uranium is not a someday or when the Brics countries do this or when Santa Claus does that. It's based on what I see happening in the market right now. So as soon as the immediate threat of a waterfall event in the markets goes down, then that puts uranium stocks back on the shopping list. And when it goes, I don't know, but it's something I'd rather not miss. I can handle a bit of volatility in front of the next leg up in uranium, and I'd rather stomach that than wait and try to chase the stocks when uranium's back over $60 a pound and all the stocks have doubled. That's not going to be the time to buy. Okay, next question sent in advance. A few newsletters ago, I said the dollar is a dead man walking. Can I expand on my view? So yes, with the caveat that this is one of those, big picture thinking ideas that it relates to what we've already been saying about the Brics. The so-called weaponization of the dollar in response to the invasion of Ukraine, I think, was a historical moment that changed everything. I think the predominance of the dollar as a global reserve currency was already ebbing. The Chinese and the Russians were already interested in getting out of under the thumb of the US in that very important financial jugular, So that was already happening. But kicking Russia out of the SWIFT system and seizing Russian assets, financial assets abroad, all this stuff, it wasn't just a wake-up call. That was a slap in the face of anybody on the not so friendly side of the ledger from the US's point of view. And so, empires rise and fall. The dollar's hegemony can't last forever. And now we see powerful agents acting to change this situation. That's what I mean by the dollar is a dead man walking. Nothing lasts forever. Does the dollar just disappear entirely? Maybe at some point. Probably not. I mean, not for a time that matters to us. They chop off a few zeros, call it a new dollar, but there's still a dollar out there. But the caveat here is that okay, that's a big picture idea. I think this, I believe this. This is the way things are going. I expect the dollar to eventually no longer be the top dog reserve currency of the world. I expect it to, over the decades ahead, become a international settlement currency, and potentially, in due course, not even a particularly important one. It could become less important than the pound is today. In the worst case scenario, it becomes like the lira or something. But that takes years, that takes decades. There's no, therefore, I'm going to buy this stock, or therefore I'm going to, there's no portfolio decision now that I would make based on this view. So yes, I think the dollar is a dead man walking, but that's a big picture context. Makes no difference right now to me as a speculator. Okay, next question is my opinion on antimony, or antimony, depending on how you want to pronounce that. And I did an interview, Molten Metals, I think is the name of the company, with the CEO of an antimony company, or an antimony company. Very interesting. But my answer, I'm not an antimony expert. I can't say that I follow the antimony market. I know the buyers and sellers. I know what the contracting is like. I'm really not qualified to say anything about where the price is likely to go. I can say it's an industrial metal, and I'm not interested in any industrial metals right now, not even copper, which I do know a lot about, and which I'm very bullish on going forward. Ahead of the acceptance, ahead of the recession deniers finally giving up the ghost, I'm looking at any industrial metals. So that makes it easy. It gives me time to collect information on antimony or any other oddball metals out there, and maybe make a more informed decision. But the term oddball metals is key here. My experience with oddball metals is that they can suddenly shoot up. Somebody who got in on titanium at the right point, or some other EM. Recently molybdenum. It's not quite an oddball metal. It's actually a pretty important industrial metal. But there was a market imbalance that caused moly prices to spike and come back already significantly. What I'm saying though is that these oddball metals, they're subject to sudden and drastic market moves. And if you happen to get in before one takes prices upwards, you can do spectacularly well. They tend not to last. They tend to be hard to predict. Say, for example, with titanium, I don't know if it's been as long as platinum. Maybe it's been longer, but I've heard stories about how titanium is going to be the next flavor of the day. Weird things ranging from the US military is going to put titanium missiles in orbit because they have the kinetic energy of an atomic bomb without the radioactive waste, to some new industrial application that was going to increase titanium demand, to some supply side story about how titanium supply was going to go away. I've heard stories like this for, I think, more than 10 years. And it hasn't worked into something that, I'm glad I never put any money on titanium speculations. So that's how I see antimony. I don't know enough to bet on it. Maybe antimony is going to be the next lithium, or the next molybdenum, or the next something that just goes nuts. Maybe. I'm not saying it won't. I'm saying I don't know enough to say that it will, and I'm not willing to bet on that basis. And that's worth stressing. I'm a speculator. I'm a disciplined, and I hope rational speculator. Means I'm pitting my intelligence against the market, looking at trends, looking at what I can see happening now. Not just some exciting story, not just some guy on Twitter said that antimony is going up or something like that. And I'm not a gambler. I never just throw the dice. I have to believe that there's a reason for me to be right, or why the market is mispricing this asset, or whatever it is that I'm speculating on. So I'm not dissing antimony, but I'm not interested in speculating in that space myself right now. Okay, next question. Similar question, I guess, for tin, the glorious market that is tin. Well, I'd say I know a little bit more about tin, and maybe I like it a little bit better than antimony. And it's less of a byproduct story than moly. And to rewind a little bit to moly, that's part of the problem, is that I don't think I've ever even heard of something that is a pure molybdenum mine, or the primary value in the mine is molybdenum. It's a moly mine. Moly is a byproduct of largely copper mines, and so you can get a feast and famine situation with moly, depending on how the copper miners are doing, or if there's an important moly byproduct copper mine that gets shut down because of a roadblock in Peru or something like that. So for tin, there are tin primary mines, and I think I understand a bit more about the use case for it. I've read the material about how, I mean, it's not just used in soldering electronics, but that is a big use. And of course, the world is going more electrical every day in many ways. So I see the use case for tin being strong, but it's an industrial metal, and I'm not buying any industrial metals plays right now. And B, it's a pretty small market. And so when you have, one producer, and you know who I'm talking about, producing a double-digit amount of the entire world supply of tin, that tells you that you're dealing with a pretty small market. And while that one or two producers have a corner on the market, and they can demand their own prices sometimes when the end users have got it. That's great for them. But the other side is what happens if there's a new producer. In a market that small, one big new mine can completely alter the balance and change the prices. And it's a small enough market that it doesn't have to be, we won't necessarily see it coming. Like if you screened the world for all the publicly traded companies exploring for and developing tin assets, you're not going to catch a private Chinese company or a state-owned Chinese company that's doing this, and they don't even tell anybody. Just suddenly a huge amount of new tin supply appears in China and just trashes demand from overseas supplies. I'm not promising that. I'm not saying I know that's going to happen. You may get tired of hearing me say about all the things I'm not promising. But when I make forward-looking statements, I want to be very careful that people don't get too excited. I'm projecting. I'm thinking about what may be. And I think it's very dangerous when the gurus get out there and tell you what will be. So long story short, with tin, I like it. I think it's an interesting market. It just makes me really nervous. I personally have not speculated on any tin plays. If I was so inclined, I think there are some that have thumbs up in my take. I could see some, a particularly exciting tin play as a buy if you dare type story, perhaps. But personally, I just think the entire market is too unpredictable for me to feel comfortable speculating, not gambling, speculating. All right. Next question. Okay, I mentioned in today's digest. It was a long night. I mentioned that gold might drop next week until Wednesday. Does that mean gold has established a floor or has a strong footholding? Well, to be specific, what I'm saying is the short-lived market reaction to the U.S. labor report yesterday, Friday, was bullish dollar, and that if gold had been trading, normally would have been bearish gold. And so there's a reason to expect, come the open Monday morning, that if nothing changes, and that's the view that remains, that we could see gold take a hit in Monday trading. Now, I think that's a misreading of the labor report. I wrote about that extensively in yesterday's digest. And by the way, audience, if you're not getting the Speculator's Digest, just use the contact form on our website and let me know, and I can forward yesterday's edition to you. Please do sign up. If you do, we won't spam you. We don't send a flood of daily advertisements. With the exception of reminders for this live Q&A session, you get one email per week. You get the digest, and that's it. But anyway, so in the digest, I explained about this, how that data, what little data we got on the response to the U.S. jobs report suggests, potential headwind for gold in the near term. But that's one data point. And I think, it's not as great as people are cracking it up to be. Today, I posted on Twitter a screenshot of some headlines, and I'm seeing other people saying, well, wait a minute, actually, that's a lot less jobs. The jobs report Friday, people are talking about, it's a beat, it's a beat. They only thought there were going to be 230,000, and there was 236,000. Woohoo, it's a beat. Well, so what? It's almost 30% less than what there was in February, and it's more than 50% less than what there was in January. And it's the lowest read in over a year. So yes, this is a sign of at least cooling in the US labor market, if not weakening. And the US labor market is the one-legged stool the Fed has been balanced on. It's the one thing that all these optimistic soft landing economists on mainstream financial media keep saying, but it's okay, everything's fine. Never mind the inverted yield curve. Never mind the leading indicators. Never mind XYZ other thing, all of which is screaming recession. Never mind, because the US labor market is so strong. Well, if that's starting to crack, that's a big deal. This may sink in by Monday. We may not actually see gold sell off in any way on Monday if this reality sinks in and people are like, wait a minute, 236, that's actually a lot less than what we had before. We'll just have to see how that goes. But if that happens, it may not last. We have all these other data points that contradict it. If the CPI print comes in, and yes, I know the Fed says that the PCE is their preferred mismeasure of inflation, but the CPI matters. People look at it. And if that comes in considerably cooler, which base effects alone suggest may do, and the cooling energy prices in the time period from which that number will be calculated also make me think that the CPI prints probably will come in lower. Maybe not the core, because that excludes energy, but the headline CPI could come in cooler. But anyway, we may see more data that, I think the markets have become too data dependent. Like all week long, all these data points where we're bearish and therefore, people were talking about no more rate hikes. And then this one number comes in that kind of sort of maybe seems a little bit more optimistic, and suddenly, rate hikes are back on the table. And, come Wednesday when the CPI print comes out, that could change again. So I think this kind of just like charging in one direction and the other on a daily basis is kind of insane. Maybe not kind of, maybe it is just crazy. You need some kind of grounding. So the question is there a floor under gold? I don't think any of this establishes a floor under gold. I'm not a technician. I'd like to think the fact that it closed above 2,000, rose decisively above and has stayed above 2,000 is a good thing. But if the news is wrong, if CPI came in really hot, if CPI actually went up, if headline went up, not like 0.1, but if it went up like 0.3 or more, 0.5%, and core went up, and suddenly people are like, oh my gosh, the Fed still has even more work to do. It's gonna have to raise rates again in May. That could really send the dollar up. That would likely send gold down. It might break below 2,000. I don't think anybody can promise you that there's a new floor under gold. And I think it'd be very dangerous to imagine that that's so. On the bright side, whether gold holds 2,000 or not in the near term, I won't say it doesn't matter, but I think it has at most the potential to create buying opportunities. The context that we're in of still negative real rates, of the Fed looking at economic realities that I think, at least, and I'm not the only one, will argue for a Fed pivot, whatever they say, and before probably other central banks. And just beyond the months ahead, just the bigger picture of all the money printing that has been done, and I think will be done again in the not too distant future. All of this is extremely bullish for gold. I think that whatever happens in the near term, whatever floor there may or may not be, it's entirely credible to see new nominal all-time highs this year. And if things get bad enough, possibly new real all-time highs this year. And and potentially next year and on ahead, depending on how crazy the governments get in response. So I don't know where the floor is. I'm just glad that the gold stocks themselves are still on sale. So whatever happens next, there's opportunity here to get in and make money on the eventual rise higher. And I'm just not too worried about the downside. It wasn't so long ago. It was just late last year where people were worried about gold going back to $1,000 an ounce, and some of these bearish predictions. None of that was true. Rumors of gold's death turned out to be quite exaggerated. And I think things since then have only gotten more bullish for gold and silver, by the way, both monetary metals. I just think silver will lag because of its industrial aspect. But I'm very bullish on both, not worried about floors or ceilings or whatever. I think with volatility, I expect both prices to go higher over the course of this year. And I hope that's helpful. Do I have a favorite junior silver mining stock? Yes, and clients know which ones they are. Well, or even which one maybe would be my top one right now. Covered it in my last clients only live Q&A session for the Independent Speculator subscribers. Sorry, but I did warn people that I won't give company specific evaluations here. All right, natural gas on the fence, $2. Is it a buy here? I'm not one of these people that likes to run around dislocating my shoulder, patting myself on the back on all the calls that I got right, because I'm all too aware of all the ones that I got wrong as well. But I did caution particularly about natural gas last year, and boy, was I right on this. And I'm not saying that natural gas will go lower. Objectively, yes, I think $2 is a low price, and eventually it goes higher. But we're heading into Northern Hemisphere summer, and Europe didn't use as much gas as it expected last winter. I don't see any reason to pile into natural gas right now. And it's tricky business. It's not as globally easily fungible like oil, or let alone gold or copper, something like that. The markets tend to be regional. It tends to be tricky. You get one LNG hub has some problem, and it affects all the producers in that area. You could have high demand, but a bad pipeline, and you could have prices go negative for your natural gas because you can't get rid of it. Crazy stuff like that happens. In the oil patch, I feel much more comfortable speculating on oil. It's an easier commodity to wrap your mind around what the macro does for that commodity, and therefore for most of the players. And natural gas, you have to be much more granular. And I have experience in the sector, but I don't know as much about oil and gas as I do metals and mining. So try to stick with what I know and what I can easily understand. The broader answer is I'd wait to see how this summer goes, and then I'd look at natural gas going into the fall. And of course, if you could beat it, if you could get there before the market realizes where natural gas goes into the winter next winter, you could make more money. But I just don't think it's safe to assume what happens. It could even be that the Europeans decide to stock up again this summer in an expedited way to head off prices. So the prices may not move when we expect them to here. I'd just not go there until I felt confident that I had a trend that it would be a rational, disciplined speculation to bet on. And I just don't see that now. And I think it's unlikely I'll see that before this summer. Okay. Thank you. Where do you see the dollar going relative to other currencies in 23, 24? Okay, so my immediate outlook is dollar bearish. And even my friend and fellow Puerto Rican, Brent Johnson, the dollar milkshake guy, he's quite willing to go there with me. We talked about this before it happened. And I asked him, could you foresee a circumstance where, the Fed led the way in tightening, looks like the Fed's going to lead the way in loosening, and therefore, dollar down, euro up, alternatives to the dollar up, including gold. And he said, yes, I can see that happening. And I thought that it would happen, and that was another call I got right. That is what has happened. My call now is I see that over the first half of this year, but then I think things start getting more dicey. I think the Europeans are going to start having more problems. The Fed led the way in loosening, but if things get scary enough in Europe, they could end up loosening more aggressively later. We'll have to see how that goes. But here's how I see it: it is actually an aberration. It's not normal for for the gold dollar exchange ratio to fluctuate so directly with the DXY. Gold is priced in dollars. It's the gold dollar exchange ratio. So it kind of makes sense, gold dollars, they should move in opposite directions. But the reality is, since 1971, when the dollar became a legal fiction rather than anything real, it's been interest rates, real interest rates, have not been the only, but have been the most powerful explanatory variable in the gold dollar exchange ratio. Why? Because they're forward looking. Yes, gold is priced in dollars. It's the gold dollar exchange ratio. But interest rates tell you where the dollar will be, or it is thought. That's the conventional wisdom, that interest rates tell you where the dollar is going. And markets are forward looking. Therefore, the markets have historically not been looking at the DXY or the dollar directly. They've been looking at real rates as traders, as an indicator for where to place their bets on gold. Over the last year in particular, that's really gone away. And it became much more directly the dollar, and specifically the DXY. The intraday wiggles, opposite direction of wiggles between the DXY and the gold dollar exchange ratio, aka the price of gold, have been remarkably strong. And I think that plays to gold's favor in the first half of this year. And other things being equal, I think the dollar milkshake would start flowing in the other direction again, and that would actually be bearish for gold, as other countries got into worse trouble and the dollar started looking like the cleanest shirt and the dirty hamper and all that stuff again. But I don't think all other things will be equal. I think this question of what happens to the dollar, it will matter, but it'll matter less. I think as things get worse, as the recession hits, the deniers give up the ghost, and people start really reacting to the pain that they're not used to in the US. I think the fear trade, I think the safe haven trade could drive gold and the dollar up at the same time. We have seen this before. Not only, we see things like the invasion of Ukraine or Russia taking Crimea, or I don't mean to pick on Russia there, but we see geopolitical scares will send gold and dollar spiking at the same time, just pure fear. That tends to be very short-lived. There are other times, though, 2004, 2005 comes to mind, being a period where dollar strength and the fundamentals for gold coincided, where gold and the dollar went up at the same time, if I'm remembering that time frame right. Rates were going up. It was dollar bullish, but gold somehow did well during that time too, for other reasons. And I think that's what we're looking at later this year. So I don't think other things will be equal. I think the DXY is in the driver's seat in the first half of this year. In the second half of this year, I think the recession's in the driver's seat. And if I'm right about the powers that be pivoting to easy money again, then that can potentially change things again to where gold and silver go up and the dollar goes back down again. At that point, it becomes a relative race. Right now the DXY is determined by relative hawkishness of central banks. In this reflationary scenario, or attempt at reflation later on this year and into next year, then I think it'll be relative dovishness. Who's got the easiest policy will determine the balance of foreign exchange. But at that point, I think the balance of foreign exchange will be less important to the gold dollar exchange ratio. Everybody's going to see inflation everywhere, and I think that's going to be bullish for gold, whatever the DXY does. We'll see if I'm right. It's not a promise. It's not a prediction. It's the most likely path, not the only path, but the most likely path I see going forward. Hi, Lobo. Do I know the In Gold We Trust report? What's my opinion of that high quality? Yes, actually. I've interviewed Ronnie Stiffer twice, run into him at conferences. I can't say we're old pals and I know him extremely well, but from my interactions with him, I actually think he's a good human being. He's one of the few Austrians who actually is an Austrian economist. He gets it. He's intellectually sound. He understands, I think, the world accurately, and he's not swayed by left or right politics and so on. I think that's very useful. A lot of my audience is Republican. A very small amount is Democrat. A fair chunk is libertarian. Personally, I tend towards the libertarian end. And the mainstream regards libertarians as kind of loonies. But I think in the financial space, being a libertarian is actually an advantage because we're more immune to the propaganda from one side or the other. And by the way, the most dangerous propaganda is not that from your opposition, it's from your own side. If I'm a Republican, I'm more vulnerable to bias coming from my own party and the people I agree with. And since it's the Republicans and the Democrats that are running the US economy and their appointees, then those biases are very important. So I actually think it's a bit of a digression here. But whether you agree with me, you don't have to agree with me. You don't have to agree with my politics. It's fine. But I think it's an advantage for me as your due diligence guy that I'm neither left-wing nor right-wing. I think that makes me less partial to these biases that I think are very dangerous to financial outcomes. So anyway, I'm saying that about Ronnie. The report is phenomenal. It's exhaustive. He's quoted my work. He's quoted the work of other people who respect. There's so much in there that I can't go through and say, I validate every single chart, every single argument. I agree with everything. I can't tell you that. I can tell you that every time I flip through there, every time I see something, I've never come across a chart and said, this is bullshit. Or, they're cherry picking the data. This doesn't really represent reality. When my eye stops, it's always like, wow, that makes sense. Or, wow, I knew this was true, but I never saw, how big it was or what the magnitude of the impact was. And Ronnie's work does a great job of doing that. Now, in terms of conclusion, in Gold We Trust, it's hard to write a report like that and say, sell all your gold, it's going to go down this year. And it's obviously dangerous to get too wedded to any permabulls. I'm not accusing Ronnie of a permabull. I'm just saying that their mission is to present information about gold. It tends to be positive, of course. In Gold We Trust. And I don't think that's wrong in the big picture setting. It's good to have that data. But I would say, like with everything, it makes sense to take things with a grain of salt. Ask yourself, what's the contrarian view? Even for that Lobo Tigre guy, you should ask yourself, he makes sense, but how could he be wrong? What might he be missing? I know I do that all the time. I try to. All right, next question. The latest political upset in Mexico. What do I think will be the outcome of the new proposal by the president to reform mining there? So the latest proposal is part of an onslaught, really. Early on, when AMLO became president, he talked pretty hostile to the resource sector. And there was a lot of question like, okay, he's talking to his base. He's going to say that. But everybody knows how important mining and the oil business is to Mexico. Is he really going to do anything that would hurt Mexico? Or can he just get away with talking about it? Get brownie points with his audience, his voter base, and just leave it at that. And for a while, it seemed like that might be all he did. But no. Things are definitely going in the wrong direction under this president in Mexico. And in my Twitter account, I've been alerting readers whenever there's been some new development in Mexico, political risk alert elevated. This latest proposal is bad. It's just unambiguously flat out bad. It would be bad not just for our investments as Canadian or US or other international companies working in Mexico. It would be bad for Mexico. If you're going to cap mining licenses to 15 years, that might not matter too much to the smallish gold and silver mines. They may have a 10-year mine life or something like that. or extend it to 15. It may not matter to them too much. But most mines that are big enough to matter, your big copper mines or your larger gold and silver mines, they have multi-decade mine lives, and they cost hundreds of millions or billions of dollars to build. Nobody's going to step up with that capital if the mine might get taken away from them when they're halfway done mining it, or a quarter of the way done mining it. Or even in those smaller gold and silver mines, you may have a 10-year mine life with these veins that you build your mine on. But usually, there's parallel veins, or you're in a camp, or there's another porphyry center for you to explore, or something like that. So your hope is always that this mine leads to the next mine, or the extension of the mine. And so that 15-year cap is really just, it's very ignorant. Nobody in the industry would propose something like that. Even Papua New Guinea, which has just been breaking barrack over the coals, they have multi-decade mining licenses, and they're as kleptocratic as many others. So it's a dumb reform. And the additional tax to go back to communities, that's political nonsense. The mining companies already pay all kinds of taxes and royalties, and it's supposed to go to support the communities. But of course, not just in Mexico, in many countries, you pay your taxes, they go into the national coffers, and they just disappear. And if anything does get built locally by the national government, they never say, oh, this is courtesy of the mining company locally that's paid all these taxes. No, it's the mayor who says, yes, I brought you this new road, or it's the governor, yes, I built this new bridge, right? So the miners never get credit for all the good that they do to their local communities if they don't go out themselves, spend the money directly, and put a big brass plaque on the bridge or the school or whatever it is. When I go visit properties, I always tell them, remember to put the brass plaque on there, because the government's never going to give you credit for this. So this is bad. And it's bad enough that I think it will face serious opposition within Mexico. The average voter might say, yeah, kick those gringos out from stealing our gold. But your Grupo Mexicos or your Peñoles, or, any of the big players in Mexico, they've got to be telling the government, look, you do this, and we're not building any more mines. You can kiss all those tens of thousands of jobs in the future goodbye. Now, does today's politician care? Maybe not. That's in the future. And you know what? By the time this proposal could go anywhere, maybe AMLO's no longer president, and the pendulum swings, the next president rolls it back, or it never even happens. So as bad as the current proposal is, it's just a proposal. It's not even legislation yet. It's just, kind of like Biden proposing his $6 trillion budget. Sorry. Sorry. Anyway, it's just a proposal at this point. Maybe nothing bad happens, but you can't just ignore it. You can't just say, oh, it's just a proposal. There's nothing bad, nothing to see here. Move along, because it's part of a trend. And, similarly, the lithium nationalization thing, you could say, well, Mexico doesn't produce any lithium. It has theoretical reserves. It's got no proven and probable reserves. It doesn't produce anything worth nationalizing. So it's just a publicity stunt. Why not nationalize something that nobody has? You've expropriated almost no one. You've done no harm, right? You're just great PR. But it matters. It shapes the context, and it certainly influences the attitudes of the people, and therefore your permittability of projects, the objections from the locals. If the message from the top is anti-mining, it encourages them to be very, I think, short-sighted about the benefits the mining can bring their community. And within the bureaucracy, AMLO's regulators are clearly hostile. There's this big issue with open pit mining in Mexico. So long story short, I'm not saying sell everything in Mexico, get out, particularly if you're a silver bug. It's hard to find an interesting silver play that's not in Mexico, or even worse, Peru right now. But it is certainly a danger to watch for. And in particular, there are some companies, some CEOs that have been able to advance projects repeatedly and get them done. And there's others that keep running into trouble. So without naming names or being company specific, that's something to look out for. And if this proposal that AMLO has does actually go forward, it looks like it's going to become law, that would be very bad. That would be, that's the sort of thing that would make me say, okay, enough is enough, and I'm going to sell all my Mexico plays. Not there yet. We'll just have to see what happens. It is a real concern. I congratulate you for paying attention, but let's not throw out all the babies with the bathwater quite yet. One more thing is just, I will keep an eye on this, whether it's Twitter or eventually my new app when that's out, or in the weekly Speculators Digest. If anything important happens on this or Peru or anywhere else where we're worried about for our speculations, I will cover that, even in the free content. Company-specific stuff is what people pay me for, but the market commentary for what matters to us as resource speculators is what I try to put out and disseminate as far and wide as possible for free. So I will be your due diligence guy on that, and will do my best to keep you informed. All right. Do I think it's likely that a stock market meltdown will pull gold and silver down? Well, I'm not sure how likely there is this stock market meltdown. The powers that be do seem to have calmed down the banking panic. My sense right now is that the odds of a near-term market meltdown are significantly less. I'm much less worried about it, which is why I'm rethinking looking for more uranium stocks. But for gold and silver, there's the metals, and then there's the stocks. And history tells us, experience tells us, very near experience as well as long-term experience, all the experience tells us that if there is a market crash, yes, gold and silver will get whacked. Yes, the stocks will go down even farther. But they will also recover very quickly. I mean, the most recent one in 2020, that was the sharpest V-shaped bottom I've seen in my career, my life. I mean, it was an aberration. So that's not normal, but it does still fit the pattern where when things get really bad, or more like when your margin clerk is calling you and saying, Mr. Smith, you don't have enough funds in your account. We are selling your stocks to cover your margin, right? You start selling everything left and right. You sell what you can get a bid on. And so when gold goes down in that kind of meltdown scenario, it's not a failure of gold. It's gold doing its job as the ultimate recourse. It's your savings of final recourse. When nothing else gets a bid, when you need money and you have gold, you can always sell it. So we saw this in 2020. We saw it in 2008. We saw it. I wasn't there in 1987 even, but I understand the same mechanic was at work there. So if there's a market crash, yes, the metals themselves will go down. The stocks will go down more. If that happens, I think it will be a terrific buying opportunity. It was in 2020. I benefited from it. Frankly, 2020 rebounded so sharply. I was a bit late to the rebound, and I didn't benefit as much as I could have. But I did. I did buy that dip, and I did very well buying in 2008. In 2008, gold even ended up the year in the positive. Gold recovered before the end of 2008, was in the black at the end of the year. So, it's painful. I'm not trying to gloss it over. If we get such an event and gold and silver get whacked, it's going to hurt. It's not going to be fun for anybody that have any of this stuff already. But it has always been, the surest buying opportunity. So should we be so lucky to have that happen? I'll have a garage sale, sell some blood, I'll do what I can to beef up my account and buy some more, not only stocks to speculate on, but bullion to lock away savings at good prices on, which is worth stressing. Those are different. The bullion is for savings. The stocks are for speculation. The one caveat would be, silver takes it on the, gold takes it on the chin. Silver takes a gut punch to the solar plexus. It goes down harder and is likely, due to its industrial side, to take longer to recover, especially in a recessionary environment. We saw that in 2022, where gold and silver both went, gold came, and silver kind of went, and it took more than a year before it really started to come back around again. I would not be surprised to see something like that happen again. The good news is that in most markets, all but one really, in a gold and silver bull market, and all but one, silver is always more than caught up with gold on a percentage gain basis. But it is reasonable to expect silver to take longer to recover this time. That's what our experience is telling us. But again, we don't actually know that there will be a crash, or at least not in the it may not even happen this year. We may get a sort of slow decline into this recession, and then the money gates may open up again, and everybody's happy, joy again. I do not think it's a given that there will be a market crash this year or in the immediate future. But yes, everything gets whacked. Absolutely everything gets whacked when we get one of those events. Will gold miners' prices, share prices rise given the higher costs of energy and labor? This is a rational question, but one must remember that Mr. Market is rarely rational. And so there's been a lot of talk about this. In the question that I addressed earlier about, why are the gold stocks underperforming gold itself? And I said sentiment and the expectation that I think most in the mainstream still have, that we're looking at a peak that will eventually go, that will in the not too distant future go away. I think that's the main thing. But a lot of other people are saying, well, no, it's because the costs are up and the miners are no longer so profitable. The mine builders are seeing huge capex blowouts and they're having to raise more money and go back to the drawing board. All of that's true. The costs are significant, but the reality is that most investors are just not rational in that way. They don't just think about. Never mind the meme stocks, but remember when blockchain was all the craze a while back, and Eastman Kodak announced that they were going to do something with blockchain. I don't remember that they even said anything about what it might be. They just said, "Oh, we're going to do something blockchainy." And this is not some junior mining stock. This is Kodak, and the bloody thing doubled just on the announcement that they intended to do something with blockchain. So just putting the word blockchain in the press release was enough for a double on the. I mean, that's insane, but it happens. It's real. Mr. Market is not always rational. I am an absolute disbeliever in the efficient market hypothesis. Markets. It's because markets are so often inefficient. They overshoot to the upside and to the downside. They get overbought and they get oversold. That's why it's possible for us as speculators to make money in them. If they were always efficient and rational and things were priced reasonably with small fluctuations, speculation along the lines of what Doug Casey and Rick Will taught me just wouldn't even be possible. We'd all be investors vying for little penny snippets of gains. So what I'm saying is, if gold makes a new nominal all-time high, becomes the flavor of the day, if the Bloombergs and the Yahoo Finances and the CNBCs of the world are just talking about gold 24/7, the gold stocks are going to go nuts. And they may not have any more gold than just the name. In the newsletters, today's newsletter, I put, it might be like Awesome Gold Inc. will be a 5-bagger just because the name. Well, it's awesome. It must be awesome gold, right? Or here's another example. You remember when Warren Buffett or somebody in Warren Buffett's shop at Berkshire Hathaway bought Barrick? The ticker is GOLD from the old Randgold that they took over. That same ticker is used by another company in Canada. So the day that came out and a bunch of people piled into Barrick because Warren Buffett did, that other stock, which wasn't Barrick, had nothing to do with Barrick, but just happened to have the same ticker symbol on another exchange, it also saw a massive increase because of mistaken piling in. So, I'd like to say that the costs matter, and to me, as a stock picker trying to find the better companies, it does matter. I don't want to buy a crappy company that I think is going to lose money, especially when good companies that I think will make money are on sale at the same time. All I'm saying is, don't get too hung up about it. If gold really takes off, the rising tide will lift all ships. I think the ones with great big gaping holes in their hulls will settle back down pretty quickly. So I don't want to buy them. But I'm not trying to encourage irresponsible stock picking here. I am saying though that don't make too much of this. It's when the market gets the bit in its teeth and it just wants to go, it will go. And I think it'll be very good for anything that is not absolutely obvious crap. should do well enough, at least initially. And then you want to be even more careful going forward with your stock picking. All righty, next question. Questions on silver hitting highs soon. It's somewhat different from the can it hit triple digits. I think not soon. I'm sorry. Here's my Darth Silver mantle here. Silver's industrial side is clearly more important every year. And going into a deepening global recession, I do think that will hold silver back. As we were just discussing after the crash, the flash crash of 2020, silver took much longer to recover than gold, and the initial recovery was much less than it was for gold. So I think that is the near-term probability here. Doesn't mean I'm bearish on silver. Doesn't mean I think silver is going down. I think that silver will lag gold until either we get just like a mania for both, for monetary metals, and they both go screaming up, or until we get to that silver supply squeeze where the industrial demand for the industrial minerals from which most silver is produced as a byproduct goes down, constraining supply at the same time that monetary demand, investment demand for gold and silver goes up. That's the perfect storm for silver. And I just don't see that being today or this week or in the near term. I see it being possible this year, before the end of this year, or maybe next year, and maybe even probable before we reach the eventual mania top of this commodity super cycle. But it's not right away. Sorry, silver fans. Please don't hate me. Just trying to tell it, call it like I see it. Or hate me if you will, but I'm still going to call it like I see it. If I was a 24-year-old who wants to become financially independent and have 40K to invest, would I go all in into gold, silver, uranium stocks? No, I would not. But it's not the metals you're picking. Right now, if I'm looking to deploy, those would be the three, particularly starting with gold and silver, and then in the nearest term, uranium adding to that. In due course, after the recession does its worst, it would definitely be copper, maybe even lithium bulls, but after the recession, we'll see. But let me add something to your question. If I was 24, no kids, no responsibilities, I could take chances. If I lost my whole investment basket, I could start over again. It wouldn't really hurt anything. I think the same argument applies to many 94-year-olds or 84-year-olds even. I think I understand, not wanting to blow your retirement and wanting to maintain your lifestyle. And I'm not telling anybody to take any crazy risks with those important things. But I am saying that if you have play money, you have kids probably, but they're grown up. They're taking care of themselves, or they should be by the time you're in your 80s and 90s, right? And, maybe if the medical technology advances as quickly as I think it will, you might live a lot longer than you expect. So definitely don't blow the nest egg. I never encourage seniors to spend down their resources. But if you've got play money and your life is taken care of, your annuities or whatever, your cost of living is covered and it's adjusted for inflation, and your kids are taking it. I think your risk profile should be more like that of a 24-year-old. Why not? What have you got to lose? It's not going to change your lifestyle. So swing for the bleachers. So my answer to this question from the 24-year-old is that I would probably go higher on the risk curve because of the limited consequences, particularly, not just being younger, but also if you're not a newsletter writer or a YouTuber, with people looking over your shoulder, then if you mess up and you lose a bunch of money, or, one of your picks goes to zero, bad, pick yourself up, dust yourself off, learn from the lesson and go on. I don't want to be responsible for wiping out anybody's money like that. So I'm not going to go that high on the risk spectrum. But if I was 24 or 94 and it didn't really matter, nobody's looking and, I'm having fun here. And I think I've picked a winner on a high stakes table, or a potential winner on the high stakes table, why not? I think that might be the main takeaway. As far as the metals or commodities, like right now in the nearest term, it would be gold and silver, and then not so far ahead, uranium, and then we'll see how the recession goes. And then just the one remaining point would just be I never go all in, ever. Like if I had 40,000 to invest or whatever it is, I wouldn't invest 40. If I'm really excited and I think the bottom is in, and I really, I'm convinced that like now is the time to deploy, I might put 30 or max 35 out of 40, but probably just 30. Because you never know, markets fluctuate. And I might get a chance to buy some of these that I like so much, 10 or 20% cheaper in another couple of weeks. So I want to still have cash to do that. And then even then, I wouldn't want to go all in, or probably not more than 35. Because what if a once in a lifetime event comes along? What if, somebody makes a honking big discovery that just somehow gets overlooked by the market? And Lobo Tigre tipped you off, or Doug Casey or Rick Roll, whatever, however you find it. What if you stumble on something that it just takes all the boxes? This is a fantastic speculation. And then there's this other sort of Uber box that you get where sometimes some of my best wins have come when I've got the spidey sense, or my wolf whiskers have tingled, and I get the sense like, I can't believe the market hasn't caught on to this. Like either I'm totally wrong, I've missed something important, or this is just an incredible opportunity. And that may not last. The market may catch on, tomorrow or the next week or something like that. So when that rare event happens, or let me put it even more simpler, when oil went to negative $35 a barrel in 2020, that was a once in a lifetime opportunity to be a contrarian at that point. And if you have no cash at that point, you have nothing to be able to invest in when something like that obvious comes along, then you'll be kicking yourself for the rest of your life. So it's not a 24-94 question. It's just an all-in question. I never go all in. And, if I was so close to being all in and then a once in a lifetime opportunity came and I was therefore all in, I would move heaven and earth to immediately raise more cash, have a garage sale, sell my firstborn, or not something, I do something to get more cash back into play, because there's always some other opportunity. And great opportunities are rare enough that you just hate missing them. All righty, next question. I've been going for 2 hours here and I'm starting to feel it on my voice, but I have a couple more questions here and I'll do my best to get to them. How much percentage of probable in a feasibility study is too much for you to take to make you go away from the depositing company? For instance, if probable 83 million pounds of uranium and just 7.1, and proven just 7.0. Okay, proven and probable. I don't have a metric on this. The question is, is there a warning sign? Is there a clear red flag if your mine reserves, proven and probable mine reserves, skew more towards the probable and not enough proven? There's no one size fits all. There are reasons why you may have more probable and less proven in some deposits. There are cases where it might be just more expensive to drill everything off to a proven level than it's worth. I could see that in, for example, with an ISR mining, where your mine isn't a tunnel in the ground, but your mine is a bunch of drill holes where you pump solutions through the ground. If your entire mine is a bunch of drill holes and you'd have to drill more holes than that to make it all proven and less probable, you could have built the mine and spent the same money building the mine before you did that. So I can see cases like that, or other cases where it may not make sense to drill everything off to proven. But bear in mind that these terms are, even though they have legal definitions, they're still kind of gray and fuzzy. You can call something proven mine reserves. What does that mean? Is it really proven? No. Even proven mine reserves are an estimate. There are times where you build the mine, you get underground, and you're proven or improbable. It's just not there, or not as much there as you thought. The model is wrong. There are assumptions that went into it that were incorrect. and they even looked reasonable. I remember one deposit I heard of where they it was a VMS lens, and they drilled one side of it and they hit high grade, and they drilled the other side of it and they hit high grade. And this was long ways, it was vertical. So they drilled the sides and it was consistently high grade. And they knew that it was this lens going this way from other holes. So it was reasonable to connect the dots and say, oh, well, we've got 20 million tons of 5% copper or whatever it was. It was a thing of beauty. It was exciting. Stock went up. And then they drilled it, they drilled these ones, and then they drilled it from an angle and they filled in the gaps between. And it turned out that some post-deposit fluids came along and dissolved the heart out of the thing. Like the thing was settled in the bottom of the ocean from a black smoker. The VMS lens was formed, and then later it became part of the earth, was faulted, tilted, and some hydrothermal fluids came through the heart of this deposit and ate it out from the inside out. There was something about the chemistry that it preferentially ate the heart of this lens of VMS mineralization, leaving a shell that hit these two drill holes. And then so when they drilled it in the middle, it just wasn't there. But before those infill holes, it was reasonable to connect those dots. They were so solid. So even so-called proven mineral reserves, you never really know what you have until you mine it. Not even when you go underground and look at it. You could look at this VMS lens. If you mined underground and you saw it on one side in one tunnel, and you saw it on the other side in the other tunnel, you might think, yeah, it's really there. And then you'd mine it and find out that it actually wasn't there. So you never really know until you have head grade going through the plant and ultimately reconciliation. That's why there is reconciliation. When you reconcile your actual ounces or pounds produced versus the model, that's when you know what was really there. So I don't get too hung up about this. There's no ratio of proven to probable. I know that there was a big scuttlebutt with Sprott getting upset with one project because they weren't happy on this basis. But that's pretty rare. In fact, that's the only case like that I can think of. And I think there are sometimes legitimate reasons why it would just be it would be silly to bring everything into the proven category. But in general, you'd rather have more proven than probable. And also bear in mind that you start with inferred is the lowest confidence category, and then you've got indicated and measured. And then when you take your measured and indicated and you put a feasibility study on it, it's those same ounces or pounds. It can be the same drill results, the same data set, that once you have economics, you can put a value on it. So your measured and indicated become your proven and probable. Your measured becomes proven, your indicated becomes probable. So it's not like, they're drilling up from inferred to indicated to measured to probable, and they just gave up and decided, oh, well, we don't need proven. We're just going to stop here. It's that you define your deposit, you do a study on it based on your drilling, and you get what you get when those measured and indicated convert to proven and probable. And whether it's then worth spending a lot of money to try to upgrade proven to probable, I think that's a big. In fact, it's rare. I'm not sure I can think of an example where a company spent money specifically just to upgrade probable to proven. That's usually happening earlier on, where you're trying to upgrade more of your indicated to measured, if it's economic to do so. So maybe that was long-winded, but kind of technical question, and hopefully that was helpful. Direct lithium extraction that is quick and environmentally friendly, as well as providing carbon. This direct lithium extraction is a new method. The main methods are hard rock mining, of course, crushing, grinding, extracting with your processing plant, or the big bulk producers in South America. They mine brines, which means they pump the salt water, and the salt in this case happens to be potassium and lithium salts, onto the surface, and you have a big, huge plastic lined pan, 5 kilometers long, black plastic sits there in the sun, in the desert, in the altitude, and the sun evaporates all the water off, concentrating your salts. So wastes a lot of water in the desert. That's a political hot potato, and it takes years. It takes a long time just to build these evaporation pans, and you fill them up, and it takes, the advantage is the sun's doing the work for free for you. The disadvantage is it takes years to recover. So yes, direct lithium extraction. It sounds very exciting and an answer to many problems. But if you haven't read it already, I highly recommend my free essay available on the website. Look for, do a search, use that little magnifying glass, search for pioneers, and read the essay, Pioneers Take the Most Arrows. So one of the things I learned from Doug Casey is, even as much as we're techno-optimists, we love science, we love the progress of technology, we don't invest in science projects. As a philanthropist, I might donate to a science project, but as a disciplined, rational speculator, I never bet on science projects. The pioneers take the most arrows. And the guys who go first, or gals who go first, they find all the things that your theory didn't predict to go wrong. They find all the potholes on the way. They take all the arrows. It's even in exploration, it's often not the initial discoverers of a deposit that eventually build the mine, but like the many properties, it's the fifth or sixth person or group to come along, figure it out, finally find something economic worth building. So my general view with something like this is, if this technology works, it's a gamble as to whether betting on it now is going to make you any money. But once it works and it's deployed in the field, it'll be obvious which companies will benefit the most, and those will then become better speculations or maybe even investments at some point. So that's one that I would personally watch from a distance, and then include it as a factor in my decision making once it becomes proven, tried and true, field tested, commercial application, not a science project anymore. Okay, next question. Can I please elaborate on my uranium thesis at this moment? Overvalued or a bargain? The general uranium thesis is very bullish. It is still a bargain at plus or minus $50 a pound. I know that uranium bugs are frustrated with it not going, where it should go, or they think it should go, or I myself am surprised that it has waffled sideways this long. But the thesis is extremely bullish, and the basics are, mine supply has been insufficient for decades. There have been sources of secondary supply that have, if not flooded the market, supplied the market, and taken the spot price and even contract prices well below the cost to produce, the average cost of production. That's obviously untenable. If nuclear power is going away, then maybe that will be fine. An industry in liquidation would be appropriate to a demand case that's drying up. But that's the opposite of the case. So the demand case is getting stronger every year. It seems like every month, new announcements and in real demand, not just, Ukraine saying that, yeah, we're going to build lots more nuclear power plants after the war. That's an if, not when question. Whereas China building more plants now and other Brics countries announcing more builds now, that becomes a when question, not an if question. And even more immediate, when the United States government becomes an end user, establishing a national uranium reserves and taking pounds off the market, as well as SPUT and some of these other funds. There are new sources of demand affecting the market now. So all of this is extremely bullish. And unlike copper or gold or almost any other metal, even lithium, after it fell off a cliff this year, is still well above the cost of production. Uranium is really the only metal that you can say, even now, even after it's risen from $18 to $50, it's gone up a lot, it's not enough. It's still too low for the industry, the mining industry, to meet demand. Only a few of the lowest cost producers, including some big ones, yes, can make money at current prices, but it's not enough. So unless the demand goes away like another Chernobyl type event just puts the kibosh on the new nuclear renaissance. Absent something like that, it's got one way to go, I think. Volatility along the way. It is one of the most solid, I think, resource speculative theses that I'm aware of. And it is a very large part of my personal portfolio right now. Hopefully that answers the question. All righty. Does coking coal have any substitute? That's actually a really good question. And the answer is no. I mean, you throw enough money at any problem and you can come up with some substitute. Like technologically, it's carbon, right? So you could, in the same way like graphite, you can make artificial graphite. You don't have to mine it. You bother mining it because it's cheaper than making it. But so technologically, it's possible to find something to substitute for coking coal. But it's I think it's important to think of coking coal as a completely different commodity from thermal coal. It's not used for the same thing. Thermal coal, everybody wants it to go away. You don't want to burn coal for heating, electricity, and so on. Writing on the wall there of all the various energy minerals, thermal coal is the one that has the Treasure Island black spot the most clearly. Everybody wants it to go away, except for coal miners. But coking coal is a completely different product. It's not used for that at all. It's used for making steel, as the questioner well knows. And steel isn't going away. We need it more and more. So unless somebody invents some new technological process for converting carbon dioxide from the atmosphere into a form of carbon suitable for steel making at a profit, or some wonderful new technology like that, which would be a science project that I would not invest on until it was tried and true and proven in the commercial application. Until something like that changes, I think coking coal is a reasonable proxy for industry in general. It's one of those things that I wouldn't buy now going into a recession, but could see myself buying if I thought the economy was heating up, in the same way you might buy iron or copper or anything else going into a rebounding economic expansion. Is it possible to work for me? It's funny. I always say I'm not hiring. And I don't think, I did put out a request for interns at one point a couple years ago. And I thought I'd get one intern or something. And I ended up assembling a team of really brilliant people who are, most of them still with me. That makes my take possible. I couldn't track 600 companies on my own, or maybe I could somewhat track them if I did nothing else. But with the team that I have, we can not just track the surface, but we can do a fairly in-depth analysis of all the drill results and material developments coming from hundreds of companies. And that came completely by accident together from me, looking for these interns. So never say never. I'm not in need now. I have taken on, beyond the interns, I've taken on more help recently. So I'm really, really not looking for anything right now. If I need something, I'll probably put out the word in the Speculator's Digest. So keep an eye out there. As coverage for my take expands, we might look for new interns to bolster the team there. If that was something somebody was interested in, you could let me know. But that would not be the case today. We've recently expanded that team as well. So right now there isn't really anything I'm looking for, and but the business is growing. So in due course, yes, that could happen. That's a funny thing. Economic headlines are not looking good. I'm talking about a deepening global recession, but it tells you something about how contracyclical. I'm more than a gold bug, and I cover a lot more than just gold and silver. But a lot of my readership is very keen on gold and silver, and that's contracyclical to the broader economy. So it's funny, for all the downturn in the broader economy, I've actually hired this year and last year. So I've been expanding while the economy has been contracting or weakening. So that's an interesting sign of the times. How do I stay looking so young, especially with the market too? Well, you're very kind to an old wolf. It's funny. My wife used to like it when I dyed my mustache and my beard black. My hair, this is natural. I don't dye anything like this. You're looking, what you see is what you get. This may not be terribly relevant, other than the stress part of the question. But my wife liked it better when I dyed my beard black and I looked younger. But when I did that, I get all these comments on the YouTubes and so on. Oh, you should get some rest. You've got all those black bags under your eyes. Are you okay? Are you feeling sick? And it's and it's not that I was tired. I'm just old. I'll be 58 this August. So I'm sorry. I can't. Cucumber cream, anything you want to name, I've tried it. This is just me. So, and it's funny, when I stopped dyeing the beard, I just let it run with however color it wanted. People stopped talking so much about the bags under my eyes. They realized that I'm older now. And, maybe I do have some of this experience I lay claim to, but I have a more practical answer to this question. And this may sound mushy, pop psychology or something like that, but I actually think this is quite important. It's not a new observation, but for anybody who's missed it, I'll say, I think one of the important things about my way of managing myself, or to quote Rick Rule, your most important enemy is to the left of your right ear and to the right of your left ear. You really need to master yourself before you can be a master speculator. And dealing with the stress and the uncertainty and the volatility in markets is a big part of that. And so personally, one of the things that I do, even though my investment portfolio is a significant part of my net worth currently, mentally, in my mind, and this is no joke, this is the literal truth. When I buy a stock, I tell myself I am spending this money. Even though I'm speculating, I'm certainly not investing. And even though I think I'm going to make money on it, I think the odds are better than 50-50 that I'm going to make money on it, or I wouldn't buy it. I don't bet on long shots. I'd rather have doubles and triples and five baggers than swing for the bleachers on twin baggers all the time and lose money more often than not. So I actually tried to win most of the time and win enough to matter. But even then, markets are volatile. Markets can remain irrational longer than the investor can remain solvent. So this is my trick, if you want to think of it, my hack. When I buy the stock, I tell myself I have spent the money. It's like, okay, I put 10 grand into this. It's like buying a $10,000 cruise around the world on a fancy ship or something, or whatever. I have spent the money. And then, if it goes down 20%, but I still like the story and I buy more, it's a new decision. I've already spent the money. I'm not worried about, oh my God, I'm in the red or whatever. I'm looking at the cost benefit analysis. I'm looking at the value proposition at that point, and I can make a calm decision on whether or not to average down, put more money at risk, because I've already spent it. I'm making a separate decision. And then in the worst case scenario, Banks Island Gold, I lost almost all my money. By the way, that Banks Island story, it's included in a free essay that's available on the website. It's called My Two Greatest Mistakes and What You Can Learn from Them. I think if you use the search tool and search for greatest or mistakes, you'll probably find it. One of the two was Rubicon, and the other one was Banks Island Gold. And so even when I lost all my money on Banks Island Gold, I didn't lose any sleep. I didn't like it. I was unhappy. I was glad that I was able to alert my readers to get out before I could. But at the end of the day, I had already expensed it in my mind. In my mind, the money was gone. And so when I do win, when I make money, and it's like, yay, it's happy days. I'm so excited. Here was an expense. Here's money that I treated as gone. And now it's provided me a gain. It's provided me with return. How great is that? So there's all upside for me, emotional upside. So this may sound like a gimmick, and maybe you can't convince yourself that it's true. Maybe your psychology is different, but for whatever it's worth, this is literally what I do. When I buy stocks, hit that button, hit send on Schwab or the email to the broker, whatever it is. Then I'm like, well, spent that money. Let's move right along. Considering joining my take, can you give me your best sales pitch? by the way, serious consideration. Well, I hope this isn't boring to anybody else, but thank you for asking the question. I touched on it in the last couple of interviews because some comments I've had from clients have really driven home to me that people just don't get my take. Until they subscribe, most people have no idea what it is. And then after they subscribe, I get emails, maybe not every week, but it's pretty common every other week or something. It's like, oh my gosh, I had no idea. This is fantastic. How do you keep up with so many companies? This is so much work. I can't believe this. Like people just, they're gobsmacked when they realize that it's, let me put it this way. Most newsletters, and I can understand why. If you're a newsletter reader, you subscribe to other newsletters. Most newsletters have some shtick, some angle, some specialty, and then a portfolio of stocks they follow or buy and recommend in that space. My take doesn't have that. My take is a response to me answering people who come up to me at conferences or even on airplanes or occasionally in the bathroom at convention centers. People follow, oh, what do you think of XYZ company? Or worse, they'll pull out a printout of their brokerage statement. What do you think of these companies, right? You always want to know what's my take on their stocks, or these stocks they're thinking about selling or buying or whatever. And I can't answer that question individually. It's illegal. So my take allows me to do that. It's my way of being your consultant without working with you one-on-one. If I was your consultant one-on-one, I'd have to charge you $5,000 an hour or something like that to make it worth my time. This way, with hundreds of other readers, it's quite affordable. It's $50 a month. And no, it's not personalized service. That's what makes it legal. But it's real. And the unique selling point, perhaps, is that I work only for you. There is no amount of money that a company can pay me to give a thumbs up on a stock, or a short seller to pay me to give a thumbs down, right? My business model is completely client focused. That's the only source of revenue for my company. There are no ads on my website. I don't take speakers' fees. I don't take commissions for referring people to conferences or whatever. All my revenue comes from my subscribers. So I work for you. And, if I like a company, I don't like a company, I may be wrong. There's sometimes I give something a thumbs down and it goes up. It's pretty rare that I give something a thumbs up and it goes down, but I miss some good ones sometimes. Don't claim to know everything. What I do claim is that I work for you. I'm unbiased, and I'll call a spade a spade. I'll give you the good, the bad, the ugly, the way I see it. So if you're at all an experienced investor in this space, and you really don't need some guru to tell you what to do or make all your picks for you, but you could use a second opinion or some help with due diligence. And it's amazing how many of these I have been to, or I have met with, or my team now has knowledge of, directly of. So that's my sales pitch, is that we work for you. It's help with due diligence. It's not like anything else out there. I'm unaware of any service that does anything remotely like this. And it's not just reporting. It's not just, type it in on Bloomberg and get a summary of the company. It's analysis. It's judgment. There is a clear thumbs up or a thumbs down, and why. So thank you for the opportunity to make sales. Everybody else, I'm sorry if that was boring, but it was a question I got, so I answered it. When is a good time for buying nickel junior miners? Okay, well, first off, we have a free report on nickel available on the website. It should be on the homepage, a link to that, or if you go to the free report section, please do look that up. I'm not a nickel bull, not only not right now, but I'm not sure I'll ever be particularly bullish. Like, not right now because of the recession. To your question, now is not the time to buy nickel plays. Nickel is an important industrial metal. It's not going away. Going forward in the future, it's going to be important, for as long as there is civilization and industry. So I'm not that kind of bearish on nickel. But there's a whole yarn about how essential it is for the electric cars and so on. And there are not only battery designs already in mass deployment that have no nickel in them at all. There are reasons for that to continue and perhaps accelerate, like the LFP batteries that have no nickel in them. They don't have quite the range but range anxiety is going away, and they don't catch fire as often as the nickel batteries do. There's a lot in there. Please read the free report. It'll outline the case. To bring a bottom line to the question, though, if I became bullish enough on the overall economy that the overall supply and demand balance for nickel as an industrial metal without the electric cars was bullish, then that would be a time for me to go into nickel plays. And it is both a metal and an industry that I understand well enough that I would feel comfortable making that call. It's not one of these oddball metals like antimony that I just don't feel knowledgeable enough to go there. When the circumstances are right, then I think nickel makes sense. And it's not going to be because of crazy electric cars, probably. But I can see a time where the macro setting is such that nickel makes sense. And I will put that guidance out in the free digest. That's, anything to do with the broader markets and the metals, the commodities themselves, is fair game for the free service. Do I have free trials? No, I do not. If you think about it, I have two products. One is my take, which, as I've said, it's not really a newsletter. It's a database of hundreds of evaluations. If I give you a free trial, I've given you the entire database. And once you've seen it, you can't unsee it. Okay, you need to stay subscribed if you want to make requests. By the way, we do take requests. So if you want to make requests and see my answer to your request, or if you want updates, if you take a snapshot of the database, you'll have my take today, but you won't know what happens when XYZ company makes a discovery, or the mine gets shut down, or they build a new mine, or the markets change, or whatever. So I think there's a pretty good reason to stay subscribed and enjoy the benefits of our continuing coverage of all the hundreds of companies we cover. But the moment you log in and you gain access to that database, you get this huge amount of value. So no, there's no free trial. But you know what? It's $50 a month. You can try it for $50 a month. You decide you don't like it, or you slurp down all the information you want. You cancel before it renews. It does renew automatically, so you have to cancel. But that's easy. Just tell us, we'll cancel it. What does it cost you? $50. Like I say in my monthly thing, you could pay hundreds of dollars for a one-time report highlighting a half a dozen companies or something. So, if you can't afford $50, you probably shouldn't be speculating on natural resources anyway. Sorry, don't need to be rude, but that's the way I see it. And as far as the independent speculator goes, it's not a database, but it's my portfolio. It's not just that I disclose that I may own some of these stocks that I write about. It's what I'm doing with my own money. And once you see that, you can't unsee it. So again, there's a huge amount of the value is delivered immediately on subscription. So there's no free trial. And there's no refunds either, by the way. If you have to click to accept our no refunds policy before you subscribe. But you know what? $50 a month for my take, it's not a big ask. And you get a huge amount of value if you give it a try. And it gives you a feel for my work, and maybe consider whether you want to try the Independent Speculator. In the Independent Speculator, it's not $50, but there is a quarterly option. And for $1,000, you can try for a quarter before going, committing to a full year or anything like that, and decide whether it's for you or not. And I understand that's not the cheapest newsletter out there. It's not the most expensive one either, but it is enough to make it worth my while, my time to produce it. And also, as I said before, I tell people before I'm going to buy the stocks, and I tell them before I'm going to sell the stocks. So the newsletter needs to compensate me for the potential higher prices or worse prices I might get by letting my clients go first. So no free samples, but I suggest just trying my take on a monthly basis as a way to ease into it, and then decide from there if you're not sure whether I can be your due diligence guy. What is my cash position? My cash position right now is low. It's around 10%. And we're at tax season, so I'm actually keeping a little extra liquidity around at the moment. 10% is lower than it normally is for me. I'm pretty active, and I'm conscious that even though I don't think we're probably going to see a market crash in the nearest term, it's not out of the question. So after tax day, after a few questions I have and my personal finances are answered, I'm looking to send more funds to my brokerage account. There's also some stocks that are rising now that are slated for sale in my portfolio. I'm going to be cleaning up my portfolio in the months ahead. So I'm looking to raise more cash because I see more opportunities going ahead. But long and short is there's no one correct answer. It just happens to be around 10% right now, and that's not a goal. It's not an aspiration or anything. It's just the random result of the day. How about the gold to energy ratio? Gold to oil, gold to residence. Well, these things are interesting, and long term, I think they tell a compelling story about what's real, what's valuable. But they change. You say gold to energy. Well, what energy? Uranium, oil, gas. These things fluctuate up and down. The gold to oil ratio is often cited. Going forward, as we electrify our cars, whether we want to or not, the governments are pushing it this direction. I think, years down the road, there will be a future where we don't burn gas or diesel in cars anymore, and that's going to change. So the use case for oil will change, and therefore it makes sense that the gold to oil ratio will change. Conversely, I think the use case for copper is only getting better. So long-standing relationships over large amounts of time between gold and copper, I can see that changing. I can see the gold-silver ratio never going back to its historical averages because of the changing use case. Platinum as well. Residence, what residence? A Bel Air mansion, a cheap little house in Fajardo, Puerto Rico or something, the national average, does it even exist? I'm not sure I find a lot of use in these things. It's sort of more like a theoretical. It reminds us of, what's real in the world. And the way that over time gold holds its own in comparison to other real assets that have, strong use cases, I think it's important. It tells us that gold's not a pet rock. It is what it is. It's a real thing of intrinsic value. Beyond that, it's not much use. I mean, I don't see changes in these ratios determining, my buy or sell decisions. I've never seen a presentation like that convince me that was a useful thesis to guide my buying and selling decisions. I tend to look more at what's happening in, the price action now, marry that with my understanding of the macro, where I think things are going. And that has worked better for me than trying to figure out these ratios. None of them have been a silver bullet as far as I can tell. I already answered, are we hiring? The answer is no, not at the moment, but you never know in the future. It never hurts to send me a CV, by the way. And if at some point, hey, we need somebody, and there was that guy who's good at that, or this girl was really good at that, we'll see. Is there any buying timing in the My Take service? No. Remember, My Take doesn't have a portfolio. There's no list of recommended stocks. My Take is me giving you my take on the stocks you request. There's no effort. I make no effort to include my own stocks in My Take or exclude them. It just doesn't matter. My Take is me answering the question of clients who request companies. What do you think about XYZ company? And I give my take on XYZ company. There's a story summary, there's the pros, there's the cons, and then there's my take, thumbs up or thumbs down, and why. So, no, there's no, since there's no portfolio, since there's no set of picks, then there's no timing there. But there is sort of general timing. Like if right now I see signs of a deepening global recession, so I'm not interested in any industrial minerals, then I'll say that when I talk about copper or iron or lithium stocks in my take. I'll say in the current context, this is a pretty good company. I like it, but I wouldn't buy any industrial metals right now. So I might provide that sort of guidance. And certainly if a company has, really material news, they spectacularly failed to deliver to the bottom line. According, they miss their guidance in some big way. Inevitably, somebody will say, oh, is that a buying opportunity? Is that a contrarian buying opportunity? or is that bad? Should we sell? And I will address that directly. We cover anything that's major news from a company, potentially thumb-changing news, gets covered on a monthly basis. Anything else that's important but not quite so major gets covered on a rotating basis as time allows. But we will analyze, how a company changes over time, and give guidance for whether it's suddenly changed for the better. Oh, thumbs do change, by the way. If a company surprises me, discovers more than I thought, or disappoints me, I thought they really had something and they're failing, then the thumb will change. That you could think of as a kind of timing guidance, but not really. I mean, my take is like Consumer Reports. It's there to help you, as opposed to do it for you. The Independent Speculator is much more full service. It has alerts in between editions. I cover the news. I sweep the news on a daily basis and put out analysis on a daily basis. This is what happened in our portfolio. This is what it means, and therefore this is what we should do, or what I'm doing. All right. My voice is definitely starting to give out here, but I see only 3 more questions, so I'll see if I can knock them out. What will happen to SILJ and GDXJ if Mexico does go through with their proposal? Will they delist the companies that are in Mexico? Having asked the question, you clearly thought about it. Your guess is probably as good as mine. I don't know that they would. I don't know that the ETFs, I don't know the managers there. I can't tell you how proactive they are. If they're prudent, I would hope that they would rebalance their baskets when there's clear bad news coming down the pike before it becomes bad news. Like if they wait until those stocks get whacked because Mexico goes kleptocratic on us, it just goes crazy. That would be, I think, a disservice. And then again, the ETF, it doesn't exist to only go up. It's meant to be a proxy for whatever's in the basket. And you can make money short or long. It's not the ETF's job to make sure that the stocks in the basket go up. It's their job to accurately represent whatever that basket of stocks is. So, I don't think it's a foregone conclusion. I think they might be very reactive, and they might not remove stocks from their baskets until they get delisted or something. If the company goes bankrupt. So don't know. I really don't have a clear answer to that, but it's just one more reason amongst many why I don't buy the ETFs. I might buy an ETF as a speculation, a short-term like day trade or something on some price movement I thought was highly likely. But in general, I just don't buy the ETFs. I'd rather pick my own stocks. I'd rather pick companies that I believe in or projects I believe in. Late to the stream, have you discussed how silver stacking pulled through a hard time? No, not as such. This is what gets me my Darth Silver moniker here. Previously, before blockchain in particular, I think it made a lot more sense to stack silver separate from gold. There's 2 things. One is, if you think silver is cheaper than it should be, and it's going to appreciate more than gold, then that would be a reason maybe to allocate more to silver than gold. But if you're going to do that, you don't need to stack it physically. You're not buying bullion to have it and to own it for long-term savings. You're speculating. You're buying it because you think the price is going to go up more than gold. If you're going to do that, why would you pay the premium to take delivery of physical bullion, let alone beautiful coins, with the extra cost that goes into manufacturing them? Makes no sense. Just buy the ETF or something, and then if you're right, you make money, and then you can use some of that profit to buy real silver or gold. As far as stacking silver, though, in today's world goes, I think if there's a Mad Max type scenario, then having some silver around to make change for your gold is probably a good thing. I think it will always be a case to have some silver, but I don't see stacking a lot of silver. Like in the bulk of my savings, if it's long-term savings, then I'm not worried about where the gold-silver ratio goes. I don't want more silver because I see more upside in silver. I just want gold and silver because it's real. It's wealth, physical wealth, that there's no short for, that I can hold in my hand and I can store myself. And in that case, it makes sense to put most of it in gold. Gold doesn't tarnish, it's less reactive, it's easier to take care of, and it's much more concentrated. You need much less space to store. $1 million fits in a briefcase. It has to be a sturdy briefcase, but $1 million fits in a briefcase. So, that being the case, why would I want a closet full of silver to do the same thing? It just makes no sense to me. I think there's some people get a little carried away with their enthusiasm about silver, and I'm not anti-silver. And I'm on the record saying I think before this bull market is done, I think silver will rise more than gold on a percentage gain basis. But to benefit from that, I buy silver stocks, not physical bullion. It's just so much more convenient to have most of my long-term savings in gold bullion with a bit of silver, in case for some reason I might need to make some change, or just because it's pretty. That's fine. But I do not think it makes sense to preferentially hoard large amounts of silver bullion over gold. I think that's impractical. And as far as how well it does in hard times, well, as a store of savings, as physical wealth, I think they're pretty much interchangeable. It's only if you got to, a Mad Max type scenario where you have such a collapse, the internet stops working, your Bitcoin becomes untradeable because, electronic networks are down, and you can't go down to the supermarket with an ounce of gold to pay for a loaf of bread and a bottle of milk. So in that case, your old junk silver will be very useful, or even silver dollars or 1 ounce silver coins will be something that a store could reasonably make change for. But that's not a kind of scenario that I think is extremely likely in the investable future. It doesn't inform my decisions as a speculator. It just means that I've got a briefcase full of silver, and that's enough for me. And I'm working on more briefcases full of gold at the moment. Hopefully that helps. Let's see. Could I please share my thoughts on the G7 summit in Japan, where Germany opposed joint venture support for nuclear energy? Well, I guess we haven't really covered that. I'm not sure how staunch the opposition amongst the political elite, amongst the people in charge in Germany, I'm not sure how really anti-nuclear they are anymore. I think they understand that the population, they've been so terrorized about nuclear power for so long that, it's politically expedient for them to come across as very anti-nuclear and to go to these EU meetings or G7 meetings and oppose nuclear, or they opposed including it in this new taxonomy, and they oppose this, they oppose that. But at the end of the day, if they were really that adamant about it, I think they could do more than they've done. I mean, their opposition has been mostly verbal, a few votes. They haven't tried to strong arm anybody or apply heavy leverage. They haven't said to Ukraine, you want Leopard tanks, you drop your support for nuclear energy. There's been nothing like that. So I'm wondering how really opposed the powers that be in Germany are or not. It might just be political grandstanding. But whatever the truth of that may be, the fact is that German opposition has not been able to derail the nuclear renaissance in Europe. Clearly the Eastern and Central Europeans are very gung-ho. The French are very gung-ho. In Germany, it's a big player. It swings a big stick, but it's not the only player. And to my knowledge and my assessment, I guess, of the news flow and what I see going on, is that things are moving in the right direction. They're moving pro-nuclear in Europe, and Germany will not be able to stop it. They may kick their feet and scream and drag and oppose or whatever, but things are moving in that direction. And I'll be very surprised if Germany can somehow stop it. I'm not even sure they really want to. And I think this is very bullish. I think we're going to see, especially after the war is done, I think we're going to see a substantial nuclear renaissance in Europe. And in due course, when the countries that have, clean, reliable, 24/7, abundant nuclear energy are exporting it to the countries that have dragged their feet and are still dealing with more expensive, less reliable forms of energy. Those countries may change their tune as well. I'm very bullish on this. I really think that it would take something on the order of another Chernobyl event to derail this thesis. It's rare that I feel this confident in a speculation in the resource sector. Any more rumors on Mexico and Brics? Well, nothing more than it's rumors. At the end of the day, I think, whatever happens along the way, this is clearly a historical megatrend. I've written about the new Iron Curtain. I've talked about, this repolarization in the world, East versus West. I think that's very real. I think over the years ahead, this is a solid and investable trend. It's something that should inform our investments. But like right now, today, am I going to buy X or Y stock because Mexico might join the Brics alliance or not, or what? I don't see it that way. This is a big picture idea that it's part of my context going forward. If it gets to the point where they're taking actions that really affect, stock positions, then, I will write about it in the digest, but it'll be clients who find out what I change in the letter. Oh, okay. Sorry. This appears to be a rephrasing of the last question. This is a good question to end on. And we're going on, I think, 3 hours here. So probably we'll make this the last one. How did physical silver help me in my personal situation? There is a story there. You can search for it. I think it's called In Defense of Hard Money. If you look for defense or you look for hard money, that should bring up the search. If not, send me an email. Use the contact form, or if you know my email, send me a message and I'll send you a link to the story. And this is a true story. This happened to me in my life. It was back in 99, pre-Y2K. I was in a sort of a migration. I happened to be in Mexico, in a Winnebago full of kids, and 5 kids, family, 7 bikes strapped to the top, all this stuff. We were hunkering down for Y2K, and I had a business plan, and I had, long story short, my job, my work, as it were, just disappeared with me when I was in middle of a transition, and it was a huge financial crisis. I had credit card debt, I had other debts, I had obligations, I had a family to feed, and my income just went away overnight, like in one day. It was just gone. So it was a huge emergency, and I immediately retooled. I pulled together a new business plan. I launched a new business. By the way, it was a newsletter before I met Doug Casey. It was called Doing Freedom. And I got investors, and eventually I pulled myself out of the hole. But the immediate savior for myself and my family was actually my silver bullion. And it was specifically silver. I had accumulated most of that as a kid, collecting coins, and then as a teenager mowing lawns and babysitting. This was back in the big bull run up to the 1980 peak. And I got the bug, and I bought silver, and I put all my savings in silver. I can't say I top ticked it. I never paid $50 an ounce for silver in my life. Not then, not more recently. But I did buy some Morgan dollars for, I think, as high as $24 for a Morgan dollar, silver dollar. It was probably the high price I paid. And you can imagine I held those for a long time. And in 1999, I certainly wasn't keen on selling any silver. But I was in an emergency situation. I had literally no other way to put food on the table. So I went to a pawn shop in Mexico, and I sold silver, and I kept my family afloat. And so, silver price was down at the time. Didn't matter. It was a concrete material value for which somebody was willing to exchange currency for me and keep me afloat. And that's ultimately what it's for. And my favorite part about this story is that a fair chunk of this silver was in old Mexican silver pesos. These were actual silver pesos in circulation that were not pure silver. They weren't anywhere near like a Morgan dollar. They were mostly, I don't know what the heck, they were some kind of alloy that were maybe 5 or 10% silver in them, silver E pesos, not solid silver pesos, from the 50s and 60s in Mexico. And so at that, eventually they discontinued those. And then, pesos became paper, and then they became other metal coins. And I don't know how many devaluations there were over the year. I was in Mexico when they lopped, was it 3 or 4 zeros off once? I remember an overnight doubling of dollar versus the peso one night. And there, I think between the 50s and 60s when these coins were minted and 1999 when I turned them in, there were probably 5 or 6 devaluations. I did a calculation once looking at all these. And I think, it was something like 1,000,000 to 1 or something on that order. It was this huge loss of value. Like if I had pesos in the bank, if I had paper pesos, then, my 1 peso that I had would be worth it would be worth nothing. It would be less than dust in the wind, right? But I had silver pesos, with even adulterated silver pesos, with just a bit of silver in them. So I went down to the pawn shop. This is 1999. It's not an all-time high for silver or anything like that. I go to the pawn shop, and guess how much they offered me for my 1 peso silver coins? They offered me 1 peso. After all those devaluations, after all those zeros were lopped off, after all those years, not even in a bull market, I got 1 peso per silver peso. And I literally went from that pawn shop to the food shop and bought tortillas and cheese and made quesadillas for my kids. So that's my silver stacking story. I absolutely believe in owning the metals physically. Bullion, to me, is not a speculation. It's not an investment. I don't buy it because I think the price is going to go up. I buy it because it is silver or gold. It is a valuable thing in and of itself that I can hold in case of extreme urgent need, like this story in Mexico, or in terms of opportunity. It's, anything you would dip into savings for. If somebody came along with a stupendous business opportunity, or I wanted to buy a new house that I needed to dip into savings for, I could see going into my bullion for that. It would be painful. It would hurt me to sell some of my beautiful, gold buffaloes or something. But that's on purpose, that you don't go into your savings frivolously. And the more painful it is for you to liquidate your savings, the better. That's what savings are supposed to be for. So I'm a big believer in stacking physically. I can't say it saved my life, but it saved my family in a very real and material way. And I'm very happy to have my stacks now, including silver as well as gold, my dear silver bug friends. Okay, well, 3 hours I think is enough. My voice is going on me, so thank you very much. I appreciate all the excellent questions. The recording will be available if you couldn't listen to the whole thing. And we'll do this again sometime. Thank you, and have a great rest of your weekend. Happy Easter to those of you who celebrate it, and happy everything else to everybody else. Have a good one, folks.